Wow, today is going to be one heck of a busy day. We got the Federal Reserve to cover. We've got earnings from Tesla to cover, Microsoft earnings to cover, and Meta earnings to cover. There is a lot we have going on today. We're going to work through all of it together. I'm excited to see how things move. We do have a rate decision coming here shortly from the Federal Reserve. So we'll go ahead and pull up the cues here as in about 20 seconds. We're going to get the news that rates have been kept stable. Let's go ahead and hold that right here on the cues. And let's watch what happens. We got about 10 seconds to go. I'll read out the news as it comes in. Stay tuned, but this should be entertaining. We'll see what Jay Powell has to say to us today and how he's going to pow us. All right, here it comes. Federal Reserve leaves overnight rate unchanged. Does not include language that inflation has made progress. They removed that. Leaves key overnight rate unchanged. No language that inflation has made progress towards the 2% goal. Not great. They're kind of sending this like that's almost a tease for rate hikes. Economy has continued to expand at a strong pace here. Let's see here. Employment inflation goals are roughly in balance. We've got the unemployment rate has stabilized at a low level. Labor market conditions remain solid, replacing reference in the previous statement that conditions have eased. They're really firming up here a little bit. Activity has continued to expand at a solid pace, that there are risks to both sides of the dual mandate, and that they expect to continue quantitative tightening. And the policy decision was unanimous. So this is where we're starting. We are starting this day off with a Federal Reserve that wants to tell you to your face, hey, yeah, so we actually might be in a place where we might end up having to raise rates because inflation's not making further progress to 2%, and the economy is strong. Now, I think that's loony bins, but then again, what I think what the Federal Reserve does are going to be two totally different things. My POV, just like we discussed with course members this morning, is that they are walking into a deflationary recession. You've got tariffs, you've got deportations, you've got cuts at the government, you've got less hiring at the government, you've got less pricing power at companies. And I'm not saying any of this to be political. I'm just simply saying you have factors that in the short term are going to compress demand. You've got artificial intelligence spending that is likely going to get cut. Not now, not today, not in Meta earnings, not in Microsoft earnings, but over the next 6 to 12 months. And now you've got a Federal Reserve that suggests, hey, you know what? We don't even need to mention that inflation is actually doing well, which is somewhat of a disgrace, really, if you think about it, because inflation has, frankly, when you look at the numbers, done pretty decently. Again, we've got PCE coming in at close to 2%. Core PCE estimates now sitting at about 2.2%. Honestly, I think Nick T put it best, so we'll go ahead and show Nick T's tweet here in just a moment. He's also got a red line of the statement for us, so we'll go through both of those. But really, somewhat of a surprise that they're coming out with what I would call more of a hawkish statement here. This is not by any means a benign statement. This is, this is a little, it's on the aggressive side. It's like, hey, we've done our job. It's almost a little bit like, dare I say, they're trying to declare, hey, look, we did it. We did it on the side of rates, and we did it on the side of unemployment. Yeah, well, let's hope it lasts. But anyway, take a look at this. Recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level. I think it's a little premature to argue that, but okay. We'll see. Let's see what Q1, Q2, Q3, all of Q1 bring us, right? So that's going to be your January, February, March employment reports. We don't actually get those until Feb 7, March 7, and then April 4th. So you've got a little bit of work to do here. Decided to maintain rates, and then they all voted in favor of it. And take a look at that. Inflation has made progress towards the committee's 2% objective. Inflation remains somewhat elevated. That is the new statement for us. So that's really going to set up the day for the Federal Reserve. Now we'll see what the Fed ends up doing when it comes to commentary. Obviously, we'll go through and do some bingo. and we'll find out how our bingo sort of aligns. Take a look here at Nick Thiermos of the Wall Street Journal telling us that, here it is, 12-month rate of core PCE is estimated to be at 2.8, and the 6- and 3-month rates are annualizing to just 2.3%, which, yeah, I mean, in fairness, that is slightly above the 2% level, so they're not wrong in saying what they're writing here. They're not wrong in telling us, hey, you know, we are sitting at a little bit of a higher level than where we previously sat. The question now just becomes, is this going to be a Federal Reserve that is going to be so aggressive that in the face of weakening factors, they would actually be as, dare I say, almost careless in potentially over-tightening the economy? I actually think there's a good chance that that's exactly what they're going to do. Now, I hope not, but I do think that that's a possibility. Now, obviously, we got to get ready now for the Jerome Powell presser. The presser doesn't actually begin for another, 25 minutes or so here. So we've got a little bit to go, but definitely some big changes here that we'll want to highlight and pay attention to in the statement. Then, of course, we'll also get insights on Tesla. I gave a little bit of an earnings preview this morning. We'll get some insights into what's going on with Microsoft and Meta. Again, I'm not really expecting to see any kind of changes in the way that they are planning their CapEx spending. I think that most changes at corporations will be way too premature at this moment. Now, the White House, also just another news since our last video, did end up withdrawing their grant freeze and loan freeze, mostly because they're tied up in court, and so they'll have to figure out something else. And then they did also suggest potentially tightening chip exports again on companies like Taiwan, or potentially even chip exports to China. So Taiwan would be the export from Taiwan into the United States of actual chips that are being manufactured. And then, of course, into China would be completed chips that end up going back to China. It's really difficult to sort of block that from happening. But they will try regardless. Anyway, so with that, let's do a quick little just initial notes, okay? So initial notes from statement, and then we'll work on bingo together. So we'll jump in over here. Let's just write down some initial notes. So the first things we have here are, and you know what? Let's get Nick T's tweet as well here on, where is it? This morning. Nick T here. These estimates are what we want to watch on core PCE. So let's grab those. Give Nick T a little bit of a screeny right here. There we go. Perfect. And then we'll grab some commentary as well. So we may as well also see what's going on in both markets, but also let's see what's going on over here, what they're saying.
Consumer confidence, or is it just like, to Steve's point, what comes out of the White House?
Yeah, I mean, of course, what comes out of the White House is going to be quite important. Granted, we might not get information on that right now, which is why the Fed can't really react, and it makes sense for them to not do all that.
Is that volume
much.
Okay?
From a data,
yeah, let me know if that volume's okay on the TV and everything.
Important to gauge to what extent the labor markets are inflationary or not. Our base case is they're not that inflationary right now. But we are worried about the pace of immigration really starting to tighten the labor market. And I think this is not really widely discussed enough. If we really start to see 3.6 million visas roll off over the next 2 years, that's likely to tighten the labor market pretty substantially. And it's going to make the job for the Fed quite difficult.
Yeah, and I think, Jim, listen, ultimately we can get into these theoretical discussions because we don't know what's going to happen. But I do know this, is that a lot of our viewers and listeners care about what happens to their 401ks, their 529s, their Roth and other IRAs and their stock funds and whatever it may be. The bond market has kind of done its own thing, right? It's raised rates even as the Fed has cut rates. So what do you and your team at Morgan Stanley see with rates and equities and bonds going forward?
So it's a really good question because effectively monetary policy is no longer the only game in town. Fiscal policy is going to play a major role. This is something that we all have to digest, we all have to take on board, and we all have to incorporate into our investment decision-making process. What the Trump administration is trying to do is have easier fiscal policy, taxes, deregulation, things like that, to generate growth and also keep inflation low. Those three things don't often hang together. So essentially, what the Trump administration is trying to do is, through deregulation, move some of the activity, business activity, more to the mid-cap sector. So we still like the equity markets. We still think equities are a good investment, but we think it's true in the broader markets, more in the mid-cap sectors, where some of the deregulation and fiscal growth policies might have the biggest impact. On bonds, we're relative.
Yeah, the thing is, all that stuff is going to take time, right? So, like, I'm going to call it a delayed upsides. So delayed upsides are fiscal spending measures, right? That's a delayed upside. Tax policy, that's a delayed upside. Tax policy slash tax cuts, right? And then, of course, the upside of less government spending and let's say efficiency, if you will, right? And then, of course, the upside, the eventual upside of AI efficiency, right? All of those things take time. All of those things are things that are nice, loud and clear from the Alcara dual arena. I love it. It's been so long since I've been there, man. I remember going through those the gates nearby there to go fight the Cow Fight Queen and get myself a D chain that I can merch. Anyway, it's an old school reference. I love it. But let me see here. Can I do? Yeah, I could just pull this up. There we go. Let's go 4x4 for a sec, just so we can kind of see what we've got going on. So, I mean, if you look at this screen right here, what you've got is risks that the Fed are toying with, right? Tariffs restrict growth at first. This is not to be political, right? It's just a fact. Tariffs restrict growth at first. They create dead weight loss, right? They create dead weight loss. Then you have government hiring supports growth. A freeze restricts growth. It's sort of like, this morning in the course member live stream, I kind of called it, if you will, like, let's put it this way. Government jobs that aren't needed are like UBI or stimulus. They create spending by printing money, and that induces demand from consumers, right? Consumption. When you removing that makes the government more efficient and less fiscally irresponsible, but it's counter stimulus and deflationary, right? Whereas this right here is inflationary. So really what Trump is going through is this era of counter stimulus at first. Okay, you heard it here first. The delayed upsides of counter stimulus are going to be, hey, we get to cut taxes, or maybe we get to cut regulation, but all of that takes time. Cutting regulation, all of that takes time. Let's listen in for a moment just to see what this one's yelling at.
Same dynamic. Look at a 1 day, look at a 2 day. Look at 30s. Look at a 1 day, look at a 2 day. This is significant. The dollar index, as you see, had already traded above its previous day's highs. You know, what we are going through right now is, and I'm not sure what I like better when I reference it, are we in uncertainty pricing or are we in disruptive pricing? Take your choice. And in either case, CNBC loves disruption. We have disruptor conferences. But it seems as though this administration, disrupting is a negative thing. It's viewed as negative. And when you look at the notion that everybody seems to bring forth, is that all you need to do is change our target from 2% to 2.5% or 2 3/4 or 3%. It doesn't make a difference. I couldn't agree with any statements more than that. With the debt and deficit issues we have, with the disruptive pricing that we have, should they move the goalposts, you know what's going to happen, in my opinion? The market will penalize them via much higher interest rates. It's a bad idea. Yeah. And we could talk about it, but in the end, if they actually do it or a senior Fed official actually voices it, my word would be buckle up.
Well, the market's already moving, and yields are indeed moving up. They are moving higher. I think it was Alan Greenspan, Rick, that said, if you understand what I said, I must have misspoke. Rick, thank you very much. All right, Bob Pisani, I hope our Fed panel is gone.
All right, so remember, we've got Powell in about 16 minutes. So we get to go through all the goodies here. Let me know if everything's okay with volume and how everything sounds, myself, TV, all that good stuff, if you don't mind, just so we can be properly prepared for good old Powie Wowie. Keep in mind, we're going to be streaming on this live stream all the way through the Tesla earnings. We'll be going through Microsoft and Meta earnings. We'll also probably go through the Tesla earnings call. Why not? We'll just do everything today, okay? I'm just going to glue myself to the seat. I already poured 2 coffees and we are ready to go. I also I heard your feedback and I appreciate it. So I know that some of you are really optimistic for basically keeping the some kind of potential option open for the alpha report, even if it's like a small monthly fee or something. Mostly just because it's really expensive to send those text messages. I just started getting the bills for the last 3 months. I'm like, oh my gosh. So that might be an option, but I know for sure those of you who want, I don't know how much that would end up being, but those of you for sure who join either Stocks and Psychology of Money or Trumponomics, you'll have lifetime access to the alpha report included. So you kind of pay once and you get it forever kind of thing. That's generally how we always do it. So, okay, let's take a look at how the stocks are moving. And we've got NVIDIA down about... not super fantastic right now, down about 6.3%. You've got even Apple turning red today. Bitcoin's still holding on to this 102 line. You know, if you zoom out for a moment on kind of just the day chart, look how often we hit this 102 line. You want to write that one down if you haven't yet. It's the 102-164 line. So do watch that. You're great. TV low. TV a little low. Okay, I'll go ahead and fix that. I appreciate y'all saying that. Okay, so if we go, let me know how it sounds when I do this. Give me 1 second.
Defensive stocks, that's about as good as it gets. And finally, I just want to point out, January's positive. What are we up 2.5% so far, Brian, on the month? So, you know, the old saying, as goes January, so
How's
goes
that?
the year. There we are, 2.5%. So Powell's going to get asked a lot about the fact that he left.
So let me know how that ended up being. I did give it about a 5 decibel bump there, so we'll see how that looks. Then we've got, what else do we have here? Well, we've got JPOW coming out as usual in a solid, okay, good. Thank you for that. I appreciate the help with that. Got JPOW coming out in about 13 minutes. Oh, we should do our Fed bingo card. All right, yeah, let's do that. We could do that. All right, I will get the Fed bingo ready. Give me a second here. It's really going to be interesting because I feel like, you know, we're not honestly expecting that much from Powie Wowie today, but we'll do it. It's kind of like you almost want him to say nothing today, right? That's the goal. Favorites, bingo. Here we go. Got my bingo board. Yeah, best case scenario, Powell's just, he gets up, decided to hold rates steady, and the F's off. Honestly, the more he talks, I feel like the more oopsies he's going to end up causing. It's just sort of my take there. What's this? I could press a goal. Pick a goal. 10 super chats. Set a timer. How you'll celebrate. I'll show you if I'm wearing pants. Oh, no! Okay, that's interesting. I've never seen that before. Your goal is live. Oh, there's like a super chat goal button now. I haven't seen that before. Okay, that's cool. And then we have informed federal workforce they must show up on time, on schedule, says Trump. Okay. Yeah, this is just, I'm trying to also set up this 4x4
A little something, Dad?
screen.
Hi. Walt rolled his 401k.
So this way we'll actually be able to have Powell up. You'll have me. And we'll get to see, you know, what's going on with stocks and notes or whatever else. It's just kind of exciting. Okay, anyway. So let's go back to here. And what we'll do is, yeah, give me some ideas for Fed bingo here. So we'll do Fed bingo. All right, so today... How about we start with, well, Jerome Powell is on time. That's always a good one, right? Jerome Powell on time. He always is. So, like, gotta admire him for that. Be like Powell. Let's try it, okay? Nick T and NYT Blondie together. These are gonna be the YOLOs. The purple tie. And what's he gonna use today? Is it gonna be let's go for laptop today. You know, like a Windows style laptop today. And then starts with good afternoon. That's always a good one. All right. And then how about says my colleagues and I. Okay. So this is just going to be like our joke column over here. All right. Then we got to have what I'm really concerned about is something like this is the bad column, right? So we'll do a bad column, and then we're going to call it the joke. I'm going to start labeling these. Column. There we go. I'll call that blue. Doesn't let me change colors. All right, fine. So that'll be the joke column. On the right, we'll have the bad column. So this is going to be we are not taking rate increases off the table. This would be bad. We are not at our inflation goal. More work to do. Could require staying higher for longer, which would be also unfortunate. We don't want to hear that. How about a deep sea question? Yeah, that's a good one. Yeah, I like data dependent. You know, that's always a good one. Data dependent. This will be the words column. Words column. Housing disinflation. That's the usual one. Housing disinflation. You know, sort of lagging aspect to that. We got the data dependence. We've got data dependent. Gets asked about getting fired again. Honestly, he probably will. Let's do the Trump column. Trump column. Will you resign? Will you get pressured to lower rates? Wait, no. Trump says he thinks you will listen. Will you? Someone asks, right? Someone asks. They have to ask that question. That'd be hilarious. You know, Donald Trump says he thinks you're going to listen to them. Will you? It's going to be data dependent, bro. And then a bonus. Okay, let's do the bonus here. Bonus. I want to try to nail the bonus. So the bonus is going to be we don't let politicians guide policy. Ooh, breaking out the pee-pee. Oh, that would be good. Help my daughter with her Girl Scout cookie goal. Let's go. 1 out of 10 pants challenge. It has been achieved, and it has to do with someone's daughter. This sounds terribly wrong. Anyway, yourcookiedealer.com. Give that a heart. Okay. So let's see here. Okay, what about what if you get fired? What if you get fired? Bonus, courts will protect me. That would be unlawful. Unlawful. The justice system will agree with me. Then let's see here. What else here? What else? The Fed is independent. Yeah, that's probably good. Policy is the Fed will remain in the independence of the Fed cannot be questioned. Okay, good. That's good. Soft landing. Yeah, honestly, some form of like I'm gonna put that over here. Soft landing / somehow declares victory, right? jobs, inflation, imbalance, some more victory over here, some victory lapping. Let's see here. Banking system sound. Yeah, that's not bad. That's not bad. Let's celebrate their first super on a live stream. Oh, that's cool. Gives me all these little like, oh, well, thanks. No boost for you for the first super on a live stream. That's cool. Okay. So what else do we have here? So we've got my colleagues and I, good afternoon, Windows-style laptop, purple tie, Nick T and New York Times Blondie, Jerome Powell's on time, will you resign, data dependent, someone asks, so Trump says he thinks you will listen, will you? You know, a DeepSeek question's not a bad idea. DeepSeek disinflation question. You know what I'd love to see, honestly, would be like, could the bursting of an AI bubble cause GDP to collapse? Let's see here. Oh, no, he'll probably say something like, layoffs remain low, which is true. But as soon as they tick up, you've got major problems. Major problems. Oh. Fed decision is a reverse psychology move. They have to get inflation lower. Yeah. Oh, yeah. A lot of what the Fed does is psychology, after all. All right. So we got about 5 minutes to go. We've got about 6 slots on the bingo board. So I'm gonna give it a second here for everybody to put some thought into their commentary. How wild would it be if Trump shows up to the presser? That would be something else for sure. For sure. That would be unusual. All right. What's going on over here? So we got some real pain over here in stocks. I mean, look at this. Nvidia is down 6%, like straight down all day long. You've got Apple's even down 75 bips. Where's Tesla? Tesla's down a whole 3% right now. Palantir's honestly holding up pretty well. Enphase sitting over there at $60, not bad. The fact that Starbucks is up with a 4% sales decline year over year on comp sales is crazy. It just goes to show that people are pricing in this sort of like Chipotle CEO. That's not supposed to be a diss, like like somebody saying, oh, it's the McDonald's version or like the Walmart version. It's just legitimately the CEO of Chipotle got hired away over here. So kind of interesting. So we'll see what similarities come from there. Then we've got, let's see here. Okay, I guess we'll keep going with the. Oh, tariff talk. You know, that's what we could do. We could throw some tariff talk on here. So let's do that. Tariffs. Yeah, you know what? What would be really nice is walks back pre-tariff policy, right? Like pre-tariff or walks back tariff anticipation policy from December 18th. That would be really, really good. So would be good. Then a few more here. Let's go ahead and throw in some of the do not welcome more labor market weakening. I like that one. Do not welcome more labor market weakening. I'll throw it in. Banking system is sound and resilient. Let's do... What else? Buy the dip on Nvidia. Stagflation would be the worst. Would be the worst case scenario. That was an interesting one. And layoffs remain low. Funny for you know, some questions about government layoffs. And then Powell acknowledges the risk, but won't pre-anticipate. You know, that could be a long time away. So did we? Yeah, we had DeepSeek disinflation question. I got 2 more. Higher neutral rate. I'll throw that one down. Neutral rate appears to be higher. One more, baby. And then Powell's coming out. Powie Wowie's kind of the dot plot. You know, he might get asked about the dot plot. Oh, you know what? Dot plot is a snapshot in time. Okay, I'm going to put that in quotes. Yeah, that's a good one. All right, bingo is ready. So let me put it in such a way that you could take a picture of it. Actually, can I do that? No, you're just going to have to kind of do it like that and zoom in. So even if I hide myself, it's not really going to work today. So, yeah, you could probably zoom in on that. It should be 4K after all. Hopefully it is 4K for y'all. Gets asked about crypto. You never know. I never know.
A dispiriting way to start the year.
Yeah, well, if the chair feels the way you feel, we'd expect him to kind of push against this and to use the market language, almost be dovish. But kind of reinforce the statement message, Claudia. And sometimes I think he likes to upset markets, frankly, sometimes.
What?
I don't think he comes out to make big reactions. And frankly, today, like trying to keep things as calm as possible and stay away from some fairly politically charged topics, which I'm sure he'll be getting about.
He should just be quiet, like do nothing. Just hey, boys and girls, we kept rates steady today. Peace. All right, we got someone here in the chat saying. Is it Miss Hedger? Mrs.? I don't know. Hedger. Did I miss market open with you? No. Mentions beige book. Ooh. So, okay, we are... Oh, there he is. There he is. Here we go. Snowball. Where is it?
Good afternoon.
There it is.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer.
This is pretty boring so far.
If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings.
Hey, do you like the 4x4 or just the TV?
Review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer run inflation expectations well anchored. Our success in delivering on these goals matters to all. Understand that our actions affect communities, families, and businesses across the country.
That's TV.
Everything we do is in service to our public mission.
So this?
We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
I guess it depends what happens. I'll go back and forth. Like questions.
Chairman Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or from to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand?
Trump.
Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
Here it is.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact. Thanks.
Okay.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So
Powell's about to get contact.
At movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive. And for that reason, we're going to be focusing on seeing real progress on inflation or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance. And I'd say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
Where's Smiley at?
No, so let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustained.
Look at that Bitcoin pump.
Follow up.
Michael
we've seen
Saylor's
inflation
buying.
expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration.
There it is.
With fiscal policy. And
Back to waiting to see.
Regulatory policy. We're only just beginning to see, and actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do. This is no different than any other set of policy changes at the beginning of an administration.
Right.
We'll patiently watch and understand, and
remember
kind
what
of
we
not
put on
be in
bingo.
a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Yeah, look, this is what we put on bingo. He walks back tariff anticipation policy. He just did that, and that would be good. He just did it.
Television and radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know, and so you're just on hold waiting to see what comes down. It's a very large economy, and policies affected at the margin, but we're going to wait and see.
If I can follow up, the idea that you feel that policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and that's what we do. And right now, we feel like we're in a very good place. Policy's well positioned. The economy's in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster. We could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy, and so we feel like we don't need to be in a hurry to make any adjustments.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes, in answer to your first question. But to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Burn. I answered you. F off. That was dirty.
Question. What reassurance can you give the American public that the Fed will continue to operate independent of politics of its administration?
As I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see they're alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark, the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that that the range of possibilities is always broad, and not just now, but always. And it's hard to be open to just how how broad the possibilities are for an economy. No one saw the pandemic coming, and it was, it changed everything. So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case, but you don't act until you see much more than we see now.
Hey, don't forget, coupon code extended through January 31st, end of the month, just a couple days here. It'll be a pretty large price increase for the Trumponomics course. Watch the video here. You'll see all about it. Tax efficiency, entrepreneurship, you name it, over at meetkevin.com. It's pretty amazing. It includes lifetime access to the Alpha Report and more.
With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and housing services, the way it's calculated for PCE. You see that coming down pretty steadily now. Yep. And that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, that then we seem to be set up for further progress. But being seen to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things. And you put your finger, though, on it's a low hiring environment. So if you have a job, it's all good. But if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half a year.
Okay.
Thank you. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, now you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
So what's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. But job creation has come down a bit too. So, if those 2 things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
We run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. And I've got no further comment than that. Thanks.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say. So I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision?
Sure, I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times, and I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that, this process dates back, thinking about it dates back a couple of years. I made the decision to bring this to the board, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't. It's not right for the Fed.
Thanks, Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. We're somewhat above that, as you know, and we want to see serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah,
good question.
We can't know with any precision, of course.
We might be there.
As I like to say that you know the neutral rate by its works. So I think at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria. Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Okay, it's pretty straightforward so far.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around?
I don't know.
And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases, and so I don't know how that shakes out. Nonetheless,
PP's gone.
You're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There's a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know. And we didn't know, by the way, in 2000 and I guess
18.
Yeah, we
Let's
didn't really
go.
know. And the range of possibilities very, very wide.
I read this guy like a book.
We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. Nope. And then the second question is just, I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
Oh, DeepSeek.
So let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that rates do appear to be abundant. As always, we stand ready to take appropriate action to support the smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon Rabinovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Jennifer.
That's a reference to like Trump, by the way.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
Oh my God.
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our, as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And a separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
I want to avoid commenting even indirectly on the conduct of tariffs. It's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, we found in 2018 there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective, at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But, we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective. And we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So Overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment has stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So
Yep.
that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level. Because inflation has raised prices. Inflation is now much closer.
By the way, all those blue wrenches you see in the chat, they're all course members. That's how you get a wrench if you want one. Meet Kevin.com.
1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy, is, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see, there's nothing in the data yet on that, but you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people.
Wrench gang, let's go.
You don't see that in the aggregate data yet, but yes, you hear it anecdotally.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today, and I'm wondering, are there any periods from your career or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this. Uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? That was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise, really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we have actually a very good economy right now.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut? Or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid. Downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
whether or not you need to see better than expected inflation data or just inflation data that roughly aligns with your current forecasts?
You know, it's one of those things, we'll know it when we see it, but more the expectation is that we will make continued progress. And, you know, that's what we want. We'll know it when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see, you know, continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And I mean, is that better than our expectations? We expect to see that. It's just a question of when.
Chair Powell, Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little bit about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if a central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. I mean, there's just no interest at all in changing it. If I'm being at all unclear, we're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't, you know, we said what we said was that, you know, at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And, you know, our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision to, we looked at the inflation as transitory, and right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot.
December 21,
at 4.1% unemployment and inflation way down. But the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
He can't answer that.
You know, so our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and you know, we think it's, you know, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and soundness. A good number of our banks that we regulate and supervise do that. You know, the threshold has been a little higher for banks engaging in crypto activities. And that's because they're so new, and we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, we're not against innovation, and we certainly don't want to take actions that would cause banks to terminate customers who are perfectly legal just because of excess risk aversion, maybe related to regulation and supervision. So,
and with respect to household,
fair answer.
That's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have. And that's why we have, the securities laws that we have. It's why, if you read a mutual fund prospectus or a individual stock prospectus, you want households to have the chance to understand the risk that they're taking. And, I do think it would be helpful if there were a greater regulatory apparatus around crypto. And I think that's something Congress was working on quite a lot. We've actually spent a lot of time with members of Congress working together with them on various things. And I think that would be a very constructive thing for Congress to do.
Agreed.
Thank you.
Okie dokie. Well, there you have Powie Wowie. So, hey, quick update. I'm gonna do a summary, and then we're gonna go right into earnings. So we're just gonna stay live in this live stream. We're just gonna stay live with it all. So if you want to be here with me for it all, buckle up, get another cup of coffee, and let's go. But first, let's go ahead and do a little bit of a summary. Honestly, I think it's going to be kind of on the short side. It wasn't that powerful in any direction, and we didn't get any kind of yapping about rate hikes, which is good. And the markets are, kind of neutral to slightly higher on it is what I would say. That seems to be a rough initial sentiment gauge there. All right, so let's do a summary. Remember, if you haven't yet, go to meetkevin.com. You get a wrench, you get course member access to the live streams, you get alerts, the alpha report. I mean, you pay once and you're in, you're a course member. And then all of a sudden, on your end, you don't even see the course pitches anymore. They're just like edited out. I'm just kidding. Anyway, all right, let's get into a summary over here. So let's see here. Press that button. Press that button. All right, here we go. Well, there we have it. Jerome Powell did not cut rates today. We are now stable at roughly an average of about 4.3% on the Fed policy rate. And while we've made progress towards that 2% in the commentary, Jerome Powell did remove the phrase "made progress towards the 2% goal" from the letter or the statement that comes out. Now, he says that's because they got rid of the "from the prior portion of the year" because now they're in January and they're not comparing to the first half of the year anymore, right? So he's kind of like walking back. Don't worry. The reason we removed the term "we've made progress to our 2% inflation goal" is because we were just comparing to the early part of last year there. But I think the big takeaways here, and we'll go through some of the other details here as well, but the big takeaway, big one, is that we actually started getting Jerome Powell walking back what happened on December 18th. Now, if you look at the stock market since December 18th, it's been a little bit more tenuous, and part of that is because hedge funds have been starting to degross after the December 18th meeting because a lot of people were comparing December 18th to December of 2021. Basically, what they were doing is they were saying, whoa, first of all, for 2 months in a row, Jerome Powell's like, we're not going to consider tariffs in our policy. We're not going to consider tariffs in our policy. And then all of a sudden in December, you get Powell and gang going, yeah, we considered tariffs in our policy, and that's why we think we're basically closer to a pause. And a lot of institutions freaked out over this and thought, wait a minute, that's the opposite of what you said 2 months ago. Now you're flip-flopping. This is bad. Let's get rid of leverage. Let's sell some stocks and let's take some risk away. But Jerome Powell really walked that back today. He basically told us that so far they haven't seen much of anything on tariffs, which is true, We haven't had any actual tariffs start yet, and the president was inaugurated 9 days ago. We have not seen any tariffs yet. We've had talk, we've had threats, but so far no tariffs. So Jerome Powell's right about that in saying we haven't seen much yet, and so right now we're just not going to anticipate any kind of actions from Trump, and we'll just take it as it comes. So basically we're going full circle here. We're going from we're going to take it as it comes to, oh, we're pre-pricing in tariffs and we're going to tighten down the hatches, so to speak, to, yeah, we're going to take it as it comes. It's a full freaking U-turn again. We just went into a 360-degree circle, but honestly, the stock market kind of likes it. It's a good thing. I mean, if you look at the cues, this is when Jerome Powell really came out to start speaking. We got our statement came out right about here. This is where our statement came out, so straight down until Jerome Powell started yapping. When Jay Powell started yapping, within about 2 minutes of him yapping, it went up, continued up, stayed up. So in other words, markets are pretty happy with what we got from Jerome Powell today. That is big, pulling that back. Something else that was pretty big is we actually got a solid acknowledgement from Jerome Powell that if the unemployment rate, if we ended up getting layoffs, then we would likely see the unemployment rate move meaningfully up. Now, the good news is we don't think we're going to get layoffs. We're not seeing layoffs right now, but it is possible that we end up seeing layoffs and they would substantially move the unemployment rate. This is something that Jerome Powell made pretty clear. He says we're in a low hiring environment, and therefore as soon as you see layoffs, we're going to see a meaningful move in the unemployment rate up. That would not be so good. And to that, though, he says we're not seeing it now, and we think we're going to end up seeing a stabilization, essentially, of the labor market to where we don't have to so much worry about it, which is kind of good. Now, when it comes to inflation, he reiterated some of Nick T's numbers that, hey, we're basically on standby in terms of watching inflation come down, that we're in a place where the PCE levels are sitting, much like Nick T said, sitting at about 2.8% over the last 12 months. The recalibration they've done has enabled them not to be in a hurry, that inflation is somewhat elevated, but they're kind of happy. And this is really what you wanted from Powell today. You didn't want Powell today to suggest that rates were on the table, rate hikes were on the table. He didn't mention it. In fact, if we look at our bingo card today for sort of expectations versus reality, take a look at what we got. We didn't get any comments about will you resign. He basically said he's not going to respond to the political questions. He did start with good afternoon and had a purple tie, but again, that doesn't matter. And, Smiley-Ack from the New York Times wasn't actually there. He was on time. He was actually asked about an AI bubble bursting, and he said, hey, yeah, valuations remain high on almost all metrics right now, including or mostly on tech and artificial intelligence. He somewhat alluded to DeepSeek, though we didn't get too much on DeepSeek. On DeepSeek, we had some sort of reference to we're all watching it, but it's really the macro impact that matters. He said higher rates are probably at the moment holding back housing, and that while they control the overnight rates, they're just watching the longer-term rates. He does say that when asked about a bubble, that households are in pretty good shape, banks are in pretty good shape, and that he supports the innovation of crypto and some kind of regulatory framework so that people are understanding of what kind of investment they're getting into. Now, we've talked about this as well, regulation coming to crypto, how you could have two different types of crypto, one that's regulated, one that's not, just so you could really read like an S1 or some kind of prospectus. Jerome Powell actually reiterated to that today. It's almost like he watched my video on it. I know I'm just patting myself on the back there. But anyway, he says crypto activities probably don't belong inside of banking in the sense that if there's any risk, they could potentially jeopardize FDIC insurance. But as far as serving customers who invest in crypto, he doesn't see a problem with that. He's pro-innovation and encourages that as long as people understand the risks and have some kind of prospectus, hey, this is great, and maybe regulation can help that happen. He says, the quote, by the way, on that headcount reduction on the unemployment rate going up was, if you saw headcount reduction, aka layoffs, you would see the unemployment rate go up because the hiring rate is low. Now, this is just sort of like a problem that I personally have with markets right now, because I think that you have a Powell that today says, hey, everything is fine, there's no problem. But what you sort of have to balance is this issue of, okay, well, from an economist point of view, just not political, just from an economist point of view, what you have is tariffs restrict growth. Government hiring supports growth, but we have a government hiring freeze. So that doesn't support growth, right? Government jobs that are not needed are kind of like universal basic income, in my opinion. I made that argument this morning with course members. Like, if somebody's at their government job and they're not doing anything, it's kind of like they're getting a stimulus check, right? And that is inflationary. That is stimulating. It stimulates the economy. Okay, fine. Does that mean it should be done? No, I'm just saying it leads to more consumption and more inflation. It creates demand, basically, induces demand. Removing that makes the government more efficient, yes, and it makes the government more responsible, but it's actually counter-stimulus. Think about that. You lay off government workers who aren't doing anything anyway, you end up having what? Counter-stimulus. So remember that. You've also got AI CapEx spending potentially to slow. You know, give it 6 months to a year, you'll see it slow down. Pricing power at companies going down. You know, Starbucks just yesterday, minus 4% year-over-year comp sales. Now, the stock's going up on hopium that the Chipotle CEO is going to, be able to do some really cool things. But the point is, you are seeing all of these ends of a candle, so to speak, burning and slowing the economy eventually. Now, Jerome Powell doesn't really acknowledge these and just sort of says, if we see those become a problem, we'll cut. My concern is that sort of cutting will end up being too late. Because really, the upsides of a Trump administration, like cutting regulation, fiscal spending, tax policy, tax cuts, and all of that stuff will take time. And time is something that an economy that's on the doorstep of a recession, a deflationary recession at that, generally just does not have. But we didn't really get much from the Fed beyond a shout out for the Meet Kevin courses over at meetkevin.com. Coupon code expiring January 31st at 11:59. Remember, you get a blue check mark in live streams. You get the course member live streams, so you get to chat in all the live streams, the public ones as well. You get lifetime access to the courses and the content, the trading alerts if you're in the Trumponomics course or Stock and Psych group, the alpha reports included for free, text, email, everything. I did take your suggestions, though, and Stocks and Psych and Trumponomics will be getting that alpha report. And we'll see. We might have a monthly option as well for people who just want the alpha report, but I suspect it'll be cheaper for you to be part of the courses. So take advantage of that before the prices go up. As far as the economy, Powell makes it clear, look, we're 100 basis points lower, so we've loosened, but we are still meaningfully restrictive right now. So he actually does acknowledge that the economy is still getting compressed somewhat by rates, but then on the flip side says GDP is fine, the economy is fine, growth is fine, jobs are fine, we just need a little bit more progress on inflation and everything is fine. Is kind of the way he came across. He also watered down FATE again, flexible average inflation targeting, suggesting that was really only designed for a moderate overshoot of inflation. And other than that, we had some immigration commentary. Now, on immigration, this was interesting. He actually talks about how Donald Trump has, first of all, had no contact with Powell. So, everybody's been sort of worried about the potential for Powell to get fired or threatened by Trump to lower rates. So far, there's been no comment or contact between the two. And Jerome Powell said flows across the border have decreased very significantly. He actually sees that as potentially a way of tightening again the labor market, which could keep the unemployment rate low. Now, this depends, though, because and he says this. He said even though you have less or fewer people coming over, you are in a situation where you also have less new jobs being posted. So you're moving in coordination. And again, this is where we have to be careful because if layoffs start happening, even though we say downside risks to the labor market appear to have abated and inflation is trending down, we don't need to be in a hurry. If layoffs start, we will see a rapid increase in the unemployment rate, too little hiring, and we'll probably cut a lot faster. So to me, bottom line out of all of this, I think that this is probably as bullish as you could have had Powell. You had no warning that we were going to have a market that should start preparing for a rate hike, which I don't anticipate anyway. I thought was kind of ridiculous, that the suggestion of it, but a lot of people on Wall Street were worried about it, so I brought it up. But it's definitely the wrong direction, in my opinion, where markets seem most focused now is going to be on earnings, and I'm actually not an earnings bear. I kind of think there's a good chance we end up having really good earnings. I mean, we've got Facebook coming out in a little bit. We've got Tesla coming out in a little bit. Microsoft, who knows? Maybe this will age like milk to say that, but I think you're going to see record profits at some of these companies, and I don't think you're going to see them say that DeepSeek is bad. I think you're going to see them say that DeepSeek is actually in something that's going to drive efficiency and drive earnings per share, and this is a good thing for Facebook and for Meta and everyone else. Welcome, Steve, to the chat. You'd be happy to know that we're now using a Dell 4x4 computer screen. You'll have to watch this morning's course member live stream to see about it. But anyway, to see which one. But anyway, we did not get Fed bingo, and that's what we got on the Fed today. So I would say overall bullish in that it really just kicks the can down the road. And now you just have to see what is the impact of potentially any other black swan, a further uninverting yield curve, that 50 to 90 range, and of course what we get through earnings. I have a hard time thinking that earnings for Q4 are going to be bad, but I also don't think we're in a place where we're going to see data that says the bond market should see higher rates anytime soon, which does mean there's a chance in the 80s here, tickers like TLT might be closer to their bottom. But then again, who knows? Everybody's been trying to look for a bottom, including myself, for a long time on TLT, and it just kind of keeps going down. So we'll see, but it just doesn't seem like we have new inflationary effects. And I do think it's interesting that Powell specifically mentions that we haven't seen much in the way of tariffs yet. That's pretty bullish from the bond POV there. So that's what we have on what Jerome Powell said today. Okay, so now what we're going to do is we're going to jump into, we'll listen to Gundlach here for a moment. I want to see what he has to say, and then we'll get into earnings. So let's listen in.
And so, but I think that the budget deficit problem is primarily responsible, I think, for this backup in long rates. Even though the Fed's cutting interest rates, this is by far the worst performance of the 10-year during a Fed cutting cycle. Usually bonds rally when the Fed starts cutting rates.
Exactly.
That didn't happen at all. In fact, rates went up. So I think that inflation is not going to easily go back down to 2%. We're well above 2%. I mean, we're at 2.9 on the core CPI and, or 2.6 or 2.7 on the headline. I mean, we got to get below 2.5, I think, to talk about putting rate cuts back on the table. And Chair Powell was quite clear in stating that we don't need to see a 2.00 inflation number, and I think he uses the PCE primarily, but we don't need to see 2% to talk about cutting rates. It's almost like it's the direction of the CPI, and right now the direction of CPI is sideways, and he needs it to start coming down. I see that the owner's equivalent rent can filter through. There is merit to that idea, but I don't really see it from the commodity complex. And we'll see what happens with tariffs. So there's a lot of uncertainty, and for that reason, I think we're only 6 days or 8 days, whatever it is, into the administration. For that reason, I think the Fed being on hold, corroborating with the Fed funds rate totally corroborated by the 2-year Treasury, it's appropriate the Fed's on hold, and so this was a.
I'll just say I don't disagree that it's appropriate that the Fed's on hold here. I just think that there's a lot that could go wrong very, very quickly, and that we're trending towards those things going wrong. So I really hope when they say they're going to react rapidly, that they actually do. That's I guess what I'm really hopeful for. So I guess we'll see. But let's keep going here for a moment.
We still believe that the yield curve continues to steepen. Irregularly, of course, but we were a negative 108. The 2-year Treasury was 108 basis points above the 10-year back in last summer. And now it's at 34 basis points positive. We've had a huge swing on that, and I think it has a lot to do with supply problems. And I don't believe that the deficit is going to improve under the Trump administration. You can find, $50 million here and $6 million there through something called, the Doge thing, or the dog E, as I call it. But I don't think you're with looking at some tax cuts and forever spending on wars and natural disasters and all this stuff. I don't think the deficit's going to go down under Trump. And that's going to be a problem with the Fed on hold. And now the bonds that were rolling off from 5 years ago with coupons of 0.5% or 1%,
refinance.
It looks like they're going to be solidly in the 4.25% to maybe 5.25% range when those bonds roll over, and there's a lot of them coming up. So the long end, I would continue to avoid it. I like the intermediate part of the market. It's not nearly as attractive as it was 18 months ago. Spreads are much tighter on credit products. The Treasury rates are lower than 18 months ago. But when you take a look at the inflation rate, even if it's at 2.5% to 3%, you have a real rate of return from fixed income. I think you should always have a real rate of return from fixed income. We've lived through so many years of repression of interest rates that we had zero or negative interest rates versus the inflation rate for a long time. We should always have a term premium in bonds, and we have one now. So bonds aren't all that risky, but I do think that under the fiscal situation that we will likely see another move up in the 10-year Treasury yield.
Wow.
Everybody, obviously, you, me, every investor, the Fed chair himself, as he made it clear today, trying to figure out what the impact on the economy and inflation tariffs are going to have. The proposed Commerce Secretary, Jeffrey, Howard Lutnick, said today on Capitol Hill that it's, quote, nonsense that tariffs are inflationary. What do you think?
Well, he's got an example to point to. It's a sample set of one, but the last time the tariffs came through, we did not have an inflation problem. Back under the first Trump administration, there were tariffs, and inflation did not stir whatsoever. So I'm open-minded on the idea that
that was back in 2018 when we were fighting deflation, right?
But first we have to see what the tariffs are going to look like. And there's an awful lot of saber rattling going on with the tariffs. If you do something that the president doesn't like, it's instantly tariff talk. And I don't know, I don't think that's really healthy as a one-tool reaction to all policy programs. You know, if you have a hammer, every problem looks like a nail. And if you're a tariff guy and you're going to respond to policies of foreign countries that you don't like and you're just constantly going to tariffs, I don't know. I think the effect of that will incrementally wear off. But we'll wait and see what the tariffs look like, and they need not be inflationary.
You have argued against the renewal of the tax cuts. I've asked you about that on several occasions. You've been pretty unwavering on that. Is that still your view today?
Yes, I want the budget deficit to shrink, and you're not going to do that by more tax cuts. So I don't really like the SALT thing in the tax cuts. I think it's really kind of absurd that was put on way back in the first Trump administration. That one I'd like to see go away, but otherwise the tax cuts, I don't want to see tax cuts. I want to see spending cuts. And I don't know if we're going to get that. Certainly history has not given you confidence that talk of reducing spending was going to result in a reality of cutting spending. But we shall see. Trump was a deficit spender in his first term, and I don't see any indications that that's going to change. And that's why I caution against high-risk positions right now, because I think long-term interest rates can go up, and valuations, as I said at the outset, are very high on credit in the bond market and on, obviously, parts of the equity market. So I'm favoring, again, equal-weighted equity exposure rather than market-weighted. That seems to have started to work. And I think fading the trends of growth versus value and small cap versus large cap, equal weighted versus market weighted, I think those got very extended. during 2024, and I would not want to.
He sounds a little rough today.
Just a momentum trade that continues. So I like equal weighted in the S&P.
I really like him, by the way.
Two.
But just off today.
Because Fed's not going to cut rates. Bonds on the shorter end to intermediate range, the price off of a Fed on hold will continue to deliver. You can get 6% fairly easily. It's not going to make you rich, but it's a real rate of return of more than 3%. And I think you can live to fight another day when you get cheaper valuations in both stocks and credit bonds.
On that note, has what I like to refer to as the Gundlach model portfolio changed in any way? You like cash. You said last time 30% cash, 50% short-term bonds, 20% in U.S. stocks. That still sound right given what we know today?
That's about right. I might change something, in 05 here or there, but broadly speaking, that's the right parameter. About half money in relatively, middle credit to upper credit bonds in the shorter, to the 5-year area, 3-year area of the yield curve. I don't like stocks at these valuations, and I would still maintain maybe some of that cash you might want to hold in a real asset, perhaps a commodity fund, which seems to be showing signs of life. And gold, I think, has another move high as well, although it is near the all-time highs. But I still think dollar cost averaging into gold makes sense in this uncertain geopolitical environment.
Sure. Before I let you go, Jeffrey, I know, and we've talked before, and I could see from some of your social media posts that you're out in the Palisades. Right. And it's really hard to comprehend those pictures, especially 3,000 miles away. Here in New York for many. I just wanted to say we wish you well. Everybody out there, our hearts with everybody. Just a terrible situation that's going to take a long time to recover from.
It's much worse than anybody realizes in terms of the disorganization. There's nobody in charge. There was no preparation. And nobody knows what rebuilding is supposed to look like or how it's going to be organized. But I was spared. I was evacuated for 3 weeks, but I was able to get back this week. And I had some damage to my property, but fortunately my house inside is completely intact. If you go through the neighborhood, it truly does look like the pictures you saw of Dresden from World War II. And all that's left in most houses is a bunch of powder on the ground and a chimney. And the chimneys are evocative of a tombstone. And there's an awful lot of them, thousands and thousands of them. It's absolutely brutal to go through the neighborhood. And it's not going to be a short period of time. It's going to be years and years before this gets to some level of stability and livability. So thank you for the thoughts, and lots of people dislocated. I've had quite a few employees have their houses burned to the ground.
Yeah, it's hard to process all of it. We wish you and everybody well. We'll see you next time, Jeffrey. Thank you.
Okay, thanks, Judge. See you next time. Good luck, everybody.
Yeah, maybe that's why he sounds a little off.
Got some big events in overtime tonight, including, Meta and Microsoft. They report at the top of the hour. We'll run you up to that next.
Yeah, okay, so we've got earnings coming out next. Kind of excited to see what happens here. We'll obviously cover it all, and we'll go through it. So we'll see what we've got. We've got markets. Let's go ahead and watch markets just to see here. We got a little bit of a slowdown right now going into the close, probably just in anticipation of earnings. Very much like you had the move on Powell, sort of the Powell anticipations showed a little bit of nervousness, but looks like maybe we'll be able to relax a little bit with after getting earnings. I really don't think we're going to be in a horrible place here, but we'll see. We'll see what we get for earnings. Very excited to see their earnings. But anyway, all right. So, okay. So, let's see what we have here. Let's see here. Okay, so Tesla right now, falling a little bit into the close. looks like you have almost a little bit of profit taking, if you will, going into the close is what it feels like. Maybe you'll taking some chips off the table, right before you have earnings. These are going to be pretty big. I mean, Tesla, Microsoft, then you've got Meta. So big expectations here. This morning on the Alpha Report, we also covered some of the volatility anticipated for some of these. We think that volatility won't be too... Yeah, he sounds like he saw a ghost. I mean, honestly, maybe he's just a little off because of the whole fire situation. That's possible, right? But anyway, Tesla 405, Meta 405, Microsoft 405, and then IBM is technically with ServiceNow at 410. So there are going to be a lot of earnings to hit really, 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 really fast. So we got a little bit of work to do. And yeah, we can go over some implied moves here. Give me a second. I'll pull those up. I'll just take a moment. We got about 10 minutes to go before the bell. All right, let's see what we have here. So... let's see here. Okay, so that's all coming up. That'll just take a sec. Then, yeah, it's been a while since we've done gotten to do a close together, huh? Market close. That is what we are going to get together today. It's a good thing. All right, let's see here. Cool. All right, perfect. All right, so let me go through some of the expected moves on these puppies and give you a little bit of a heads up. So, expected move on Tesla, I think it was 8.4%. 8.49% is Tesla's expected move. Then we have Meta with an expected move of 6.81%. Should really write those down. And then we have Tesla, let's go MSFT. Microsoft expected move is 4.19%. All right, so that's it's pretty benign, honestly. Just a lot at once, like technically all the same minute, right? So that's gonna be a little wild, but that's okay. We can handle it. Okay. So, okay, one sec. Okay, let's listen in here for a moment.
And we're dealing with our other issues in terms of a concentrated market, dealing with a rethink of the AI trade. And so you do have more stocks down than up. We're chopping around the 6,000 mark in the S&P. No big deal there. But I do think the bond market is still sensitive to this idea that higher for longer might again create this test of whether the economy can handle and the housing market can handle rates up here. But so far, okay.
Steve Cohen yesterday talked about valuation of the market. Yeah. Fed chair today was asked about it, said valuation metrics somewhat elevated by almost any metric. Sure. Now he made the point he was like looking at tech and AI, but look, when the Fed chair says something about the valuation of markets, you sit up and take note.
You do. Now, he didn't walk into that room kind of wanting and intending to make a broad comment about equity valuations, but when asked, he did observe that it's hard to ignore the fact that valuations do look elevated. It's just what reality tells you. We're going to hear from these companies today that trade at 30-ish times forward earnings of the biggest companies in the world. There's no way of saying that that's not elevated. What he did say, though, is it's nothing systemic. It doesn't seem as if financial market participants are way out on a limb or that the banks are vulnerable. So from their perspective, that's just what stock markets do. They sometimes, overshoot.
It's going to be a big evening, obviously. Meta and Microsoft and Tesla. We'll talk Microsoft first with you, Steve Kovac. What do we most need to pay attention to?
Yeah, it's going to be CapEx. DeepSeek has just raised all these new questions,
not going to
Scott,
change
about capital expenditures for artificial intelligence.
You think it changes in a day?
$80 billion for this fiscal year of 2025 ending in June. $80 billion sounded reasonable in order to win this AI race that we've been talking about so much. And then DeepSeek just really shook up that narrative. So I really expect on this call starting at 5:30 tonight for Nadella and his CFO, Amy Hood, to really talk about whether or not they need to continue spending. I will give them credit, though. Over the last several quarters on these calls, Scott, Nadella has said we are always gauging our demand for artificial intelligence. The demand is there. We can't meet that demand. But if we see things move the other way, we're going to be nimble, we're going to be dynamic, and pull back spending if we need to. So it's going to be on everyone's mind today, going into that call, will they give some sort of indication if that $80 billion needs to come down, and going into the back half of the calendar year, if they're still going to be accelerating these AI investments, or if they're going to be pulling back a little bit and taking a pause and really looking at the landscape here and seeing what they've learned from this DeepSeek moment in the market.
No. Dude, it's way too soon in my expectation. Way too soon to expect that we're going to get like some huge adjustment in spending or whatever announcements from Microsoft falling into the close, by the way, here. Meta falling into the close a little bit. Tesla. There's no way you adjust CapEx within 48 hours of this DeepSeek announcement. Just take it easy. Hey, we're going to take what we can learn from the efficiency. That'll help us grow our margins. No changes to plans yet right now, but we'll let you know. You know, it's, come on. I don't know. It seems pretty basic, but I did just post in the chat, subscribe if you have big pee-pee. So only subscribe if you have big pee-pee. All right, let's keep listening.
To do in this AI race happen. So yes, it's been a short amount of time, but it is the question on everyone's mind, is this spending justified? And I'm sure we'll find out in just a matter of hours here.
We will, and we'll be with you when that happens. Steve, thank you.
With
Steve
you.
Coe, back to Julia Borston now on Meta, trying to figure out what the over-under today might be on the words open source. How many times we might hear that?
I'm sure we will hear a lot about open source and also a lot of questions about capital expenditures. Just last week, Mark Zuckerberg pre-announced up to $65 billion in CapEx this year. And of course, a lot of that is about building out AI infrastructure. And AI will, like with Microsoft, be center stage for Meta. Now, Meta shares are up 68% in the past year and up 8% in the past week. Meta has been a rare mega cap tech stock that has benefited from the surprise explosion of DeepSeek because it's Meta's open source approach to AI, and also because Meta is seen as a key beneficiary of AI, both in terms of its ad business and in terms of its consumer chatbot, My AI. So Meta AI. So the question now is how Meta's AI investments are going to pay off this quarter. Just last week, the company guided to that $65 billion in CapEx this year, but revenue growth is expected to slow to 17% this quarter and to 14% in Q1, down from 19% last quarter. So we'll have to see whether these new AI tools, whether more monetization of Messenger and WhatsApp, the fact that ads are coming to Threads can all help rev up growth and stop that declining revenue growth rate. Back over to you.
All right, Julia, thanks. We'll look forward to those numbers when they hit and your analysis, of course, when they do. How are you thinking about these now?
Yeah, it's fascinating. I mean, Steve mentioning how Microsoft has really decelerated and been an underperformer for the last year. But in the first year after the unveiling of ChatGPT, Microsoft got all the benefit of it. So it's much, to me, more about the sequencing of how the market is now reading how AI plays out and flows into the company's bottom lines. I could make the argument that the expectations are pretty low for Microsoft. But again, you had such a massive ramp that we've just been consolidating for a while. It's still 31 times forward earnings. I don't think it's necessarily make or break for the overall market. You can have some of these do well and some of them have more of a reset lower. And we've seen this over the last 6 months, that the market can absorb that on some level as long as they're not all down at once. So open-minded about it. I think Tesla is interesting. It's obviously got a massive meme factor involved in terms of why the stock does what it does. It's 20% off its highs. It's below where it was in November of 2021, but it's up massively since the election. So to me, that's a crapshoot in terms of how we read the long-term kind of mission and story there.
Yeah.
I mean, it's the first time.
It's all a crapshoot. We'll see. Or that's why I don't like trading earnings.
That he's going to be asked about all the hats that he is wearing.
The worst thing about earnings is if you're wrong or you're right, you can't take your profits or take your loss until the next morning on options. So you're kind of sitting there like, you know, either really excited and then that could U-turn by the morning, or really pissed, which could get worse.
He'll be asked specifically, how would deregulatory moves accelerate the robo-taxi adoption, or whatever the company and the stock have been given credit for as being better positioned under the new administration? Talk about specifics and practical terms and tangible ways. Maybe that'll come through here. But, you know, again, we're trying to figure out if this market can make its way forward without that kind of concentrated leadership.
You know, and as it relates to CapEx from the mega caps, I mean, any pullback in any way, I couldn't imagine would be viewed other than positive. We've been questioning how much these companies are willing to spend. It's the fall-on effect for the NVIDIAs of the world that you would first look at, and the others, the Broadcoms, which were negative again today, and stocks like that.
It's certainly a net loss for the hardware companies, but also, I mean, you have to wonder exactly how you make your peace with how much has already been spent, whether some of it's viewed as sunk cost, whether they're seeing diminishing returns. Everyone seems to know that ultimately you spend up until you perceive you're getting to a wall. Nobody knows where the wall is. We don't know if it's close or far. So it'll be interesting to see how they characterize that.
All right, good stuff, Michael. Thank you very much. That's Mike Sansoli. Bell's going to ring us out. Red Fed Chair says no hurry. No move today, and maybe no move next time, and then we'll have to see after that. But that's it for us. Big earnings coming up.
That's the end of regulation. Brinker International ringing the closing bell at the New York Stock Exchange. Willdan Group doing the honors at the NASDAQ. Stocks mostly lower in a choppy session as the Fed holds rates steady and signals potential concerns on inflation, while NVIDIA pulls back on fresh worries about export controls. Now, attention turns to one of the most important hours of earnings season. That's the scorecard on Wall Street, but the action is just getting started.
Yeah.
Welcome to Closing Bell.
Cool little intro there. That'll all start in just a moment, actually, here. So we'll see. Kind of exciting to see what we get. We are going to be. I'm looking right now for the slide deck to come out on Tesla. Let's get. Why don't we get the 4x4 going? That way we could try to see that as soon as possible. And let's get those Tesla earnings, Microsoft. Let's make sure these are all ready to go. Microsoft. It's going to be entertaining. Okay, Microsoft just came in. Revenue beat 69.6 billion, 68.92 expected. Cloud revenue, slight miss on cloud, actually. Oh, that's really interesting. Slight miss on cloud. 25.5 on intelligent cloud versus 25.89 expected, and cloud revenue at 40.9 billion versus the 41.1 expected. So you actually get a slight miss on Microsoft on cloud. It's dropping about 4.5% right now in the after hours here on that intelligent cloud miss. And Meta is not out yet. Tesla is not out yet. I'm just watching Microsoft right now take a little bit of a tankla-padoozles on cloud there. Looks like we literally just went from 440 down to 420. Again, that was a misses slightly on cloud. Let's go ahead and just do a quick little update on that. But yeah, let's listen to them over here. Let's see what we got. Let's go 4x. Here we go.
The street was looking for revenue, a slight beat here, 69.63 billion versus the 68.78 billion expected. And Azure growth was right in line at 31%. Street was looking for 31.1%. We see shares selling off about 5% here. I'm going to keep digging in, find out what's going on, and get back to you. But those are the top and bottom lines for now. We see shares off.
Artificial intelligence annual recurring revenue comes in at $13 billion now, and Q2 rev was 69.63 versus 68.92 billion expected, which is a beat of 69.63 divided by 68.92. So they still, I'll do the math on that later because we're going to get other earnings coming out. But intelligent cloud misses. That's where the miss was. 25.54 billion versus 25.89 billion. That's what people are going to be paying attention to. Meta is still not out yet, and we are now waiting for Tesla and Meta. I'll do some math quickly. 69. Let me see what they missed by. 25.54 divided by. Oops, did not mean to do that. There we go. 25.54 divided by 25.89. A little bit of a glare. There we go. 1.35% miss on Intelligent Cloud. So it's not like it's a big deal, but it's a little bit of a miss, right? So then 69.63 divided by 68.92. This is your total, about a 1% beat on total. Okay, Tesla comes in, slight miss on adjusted EPS, slight miss for Tesla. The numbers are out. I've got a 2-cent miss on adjusted EPS. Stock coming down a little bit right now. Do not have the shareholder deck yet. Less cost reduction than previously expected. Okay, I don't know what that means. Less cost reduction than previously expected. And then we had 73-cent adjusted EPS versus the 75-cent expected. Revenue's a miss, boys and girls. 25.71 billion versus the 27.21 billion expected. Tesla's now down about 3% after this. Okay, we've got lower cost reductions regarding manufacturing lines. Cost reductions less than expected at manufacturing lines. Oh no, the gross margin got hit. Gross margin gets hit, boys and girls. Gross margin hit at 16.3%. The estimate was 18.9%. I've got regular EPS coming in at 66 cents. 66 cents for regular EPS. And then we've got record deliveries in China. Okay, well, the stock is down about 4% now after this. Then I'm looking now to get inside, no Meta yet, still no Meta yet, waiting for that Tesla shareholder deck. As soon as I have that shareholder deck, we'll be jumping into the shareholder deck. I'm also going to be, Cybercab is scheduled for volume production starting in 2026. We've heard that before. I am waiting now to get data on Tesla stock, now down 5.8%. I'm waiting now for data on Meta. We do not have Meta out yet, but we do have a miss here on what's it called? Tesla. A little bit of an oopsie doopsie there. Let's go ahead and see what's going on the slide deck. Slide deck is out. Let's go for the slide deck. Okay, so increased AI training compute by 400%. I don't know that markets want to hear that right now, honestly. I do not know. Over 3 billion miles of cumulative FSD, completed Mega Factory Shanghai. That's actually good. I like hearing that. Operating cash flow of 4.8 billion in Q4. Free cash flow. That's 2 billion of free cash flow in the fourth quarter. That's pretty good. I'll give them that. I like that. Record here for vehicle deliveries. Still no Meta, by the way. I'm waiting for Meta here. Okay. That's why Elon was quiet, somebody says. Oh, is this why quiet? Is this why quiet? Ooh, interesting. That's pretty sloppy right there, but that's okay. I just wanted to throw your comment down so I could reference it later. Significant investments in infrastructure for the next wave of growth, including manufacturing capabilities for new models. So there's this talk again about manufacturing capabilities for new models. But again, we're not seeing what kind of models yet. Affordability remains top of mind. Let's see if we have anything here. Scheduled volume production. Sees vehicle business returning to growth in 2025. Still no Meta. Affordability remains top of mind. Working on our cost of goods sold to alleviate this concern. Lowest ever cost of goods sold at under $35,000. Energy business, highest gross margin generation ever. Mega Shanghai is going to begin ramping. This is actually really good, honestly. I mean, I like this so far. This is good. This will be a seminal year in Tesla's history as we continue to improve FSD, working on launching FSD in Europe and China. Okay, fine. There's our margin. You can see that hit to margin right there. Not great. And this is going to be including regulatory credits, right? So remember that this is including credits. So that means once when we factor in some of the credit numbers here, we're going to get a little bit more of a hit on this. I'm also surprised, I will say, that I don't have meta numbers yet. So I'm just sort of looking at what's going on here. With the advancements, I want to see this. Where is this? With broader macro. Where was that comment? Oh, here we go. Look at this. With the advancements in vehicle autonomy, okay, not great here. What is this? Let's see. With the advancements in vehicle autonomy and the introduction of new products, we expect the vehicle business to return to growth in 2025. The rate of growth will depend on a variety of factors, including the rate of acceleration of our autonomy efforts, production ramp, and the broader macro environment. We expect energy deployments to be up at least 50% in 2025. I agree with that, especially with the mega cap movement. None of this is really particularly surprising so far. I think the stock is having a little bit of an overreaction. We have sufficient liquidity to fund our project roadmap. That's fine. Strong balance sheet. This is all true. Nothing to say here. Okay. Margin miss. Would like to get a little color on the margin miss for sure. We had free cash flow of $2 billion, a little less than the last quarter that we had, but a little bit more than the quarter before that. So just sort of watching those free cash flow numbers. Tesla stock down, it's recovering a little bit right now, down about 3.7%. Looks like you've got some recovery here, not bad. Let's see. None of this so far is scary, mind you. This is all kind of to be expected. We didn't get like a new car announcement or whatever, but none of this surprisingly expensive or like super bad. Higher regulatory credit revenue. So this isn't great because we expect some of that those regulatory credits to be removed at some point. So that's going to be something to watch for. Growth in vehicle deliveries, a little bit, like barely a growth in deliveries there, right? Profitability, reduced selling prices got hit, or reduced selling prices hit them. Increase in operating expenses driven by AI. Yeah, well, this is going to be one of the market's first tests to see how much do they want to see on spending for artificial intelligence, right? That was, and I want to see, where was that profit line? That line about, let's see, gross X credits. Whoa, margin X credits was only 13%. So let me do this really quickly. Let's erase that. Margin X credits was 13.6%. Someone commented on AI compute. Is that why Elon was quiet? There we go. Clean that up a little bit. Okay, that's better. But that is pretty low. Got a little bit of a boost in the stock now. It's only down about 2.5% right now. The stock's doing just actually kind of fine given how rough some of these numbers are. Okay, the regulatory credits were 692 mil in credits versus credits down from 739 mil last quarter. Stock's only down about 2% now. Let's see here. Okay. Affordable. I'm going to look for affordable. Preparations are underway for the launch of new products in 2025, including more affordable models. We've seen this line for a while. We don't know what this means. So I think if Elon wants to pump the stock today, he could give us some color on this. And I think that would very rapidly pump the stock. Still no meta. This is weird. Okay, with the advancements in vehicle and autonomy introduction to product. Okay, we read that. Let's see here. Okay, that's all old news. Okay. Let's see here. Somebody in the chat says they killed their margins and couldn't surpass 500K deliveries. That is not untrue. So the margin hit here is a little poopy. This is where they talk about deploying a fleet of Cybertrucks equipped with Starlink to help first responders. I kind of a little bit think that's more of a marketing thing, and they didn't actually need, like, they actually kind of had an oversupply of these. Oh wow, IBM's up 11% on their earnings that just came out. Semi-factory construction continued in Q4. We included the walls and the roof. First trucks are expected to be built by the end of 2025. Okay, preparation is underway for cybercab lines at Giga Texas. Planned operation or volume production 26. Best-selling Model Y vehicle, fast selling in various different regions. That's fine. What do we have here? Okay, this is... Dude, where's Meta? This is so weird. It's supposed to have been out a bit ago. But anyway, we completed the deployment of Cortex, a 50,000 H100 training cluster at Giga Texas. So a lot of people are going to question, like, was this necessary anymore, right? For FSD. So we'll kind of see. ServiceNow and IBM. ServiceNow down 10%. IBM up about 11. 2x, what do we have here? Let's see. Higher resolution video, 2x. Reduction in photon to control latency, among other enhancements. You know, I've never heard of that phrase before, this photon to control latency. I understand, but it's sort of like, is this an excuse? I mean, I like, because I just haven't heard them complain about that before. Or are they just trying to provide more detail? Okay, let's see. Holiday release. Holiday release included Apple Watch support. Are you serious? Oh, I didn't know that. Shit. I figured that out right now. That's awesome. Where did I put my watch? Oh, there it is. I'm sitting on it. All right, and I have to check that out. That's great. Sirius XM now available. Blah, blah, blah. Powertrain, manufacturing. Let's see here. Lithium refinery, 18 months after groundbreaking. That's fine. We are now at 2.5 thousand Cybertrucks a week with 4680 production, which is honestly pretty good. And people are regularly asking, like, hey, I feel like every single earnings call, they're like, hey, man, how are the 4680s doing, man? Like, I want to know. And so far, seems to be pretty bang on decent. Okay, energy business continues to grow rapidly. Energy storage, 11 gigawatts for Powerwall Megapack. Record gross profit Q4. Totally agree with that. Material costs down. Yeah, batteries. See, this is actually a great business because batteries are getting cheaper. Margins at Tesla very high here, which is very, very good for Tesla. Big fan of this, mind you. This is good. Okay. Added over 3K supercharger stalls. Battery heating at superchargers that gets vehicles on the road 4 times faster. I've seen that update come through a few times, the little notice. We're preheating your battery. I think it's great. And mostly on the Cybertruck. I don't see it on the older ones yet. Okay, good. Sufficient liquidity, strong balance sheet during this uncertain period they talk about. Okay. Plans for new models, including more affordable vehicles, remain on track to start production in the first half of 2025. Okay. These vehicles will utilize aspects of the next generation platform as well as our current platforms. This approach will result in achieving less cost reduction than previously expected, but enables us to prudently grow vehicle volumes. Oh, that's where they're pulling that? That's not that big of a deal. Okay. This should help us utilize our current expected maximum capacity of 3 million vehicles. Okay, enabling 60% growth over the 2024 production before investing in new manufacturing lines. Right, but we don't know when we're going to get that 60% growth, right? And they're not forecasting that either. 60% by 26, 27, 28. It's just worth remembering that note there. Okay, so am I just like oh, is Meta? How come I'm not seeing it? Is this thing frozen? Let's see here. Company news. Maybe that's just frozen. I don't actually see it. Everybody's saying Meta's out, but I don't see it. Nah, I don't see Meta yet. Anyway, we'll keep going with Tesla. Okay, photos and charts. Average cost per vehicle. I mean, this is beautiful. But the numbers on the left, like, watch the scale on the left, right? The scale on the left isn't that bigly. Scale on left goes from 38-ish to 34.8K. So, you know, there is a reduction, obviously, here. But the Tesla guide for vehicles, I have not seen a guide. Outlook doesn't look very bullish. Let's see. A lot rides on the call, comments. Zero mention of a Mexico plant. You're not going to get that. Let's see here. No. Nope, no mention of that. Design. This is a fancy new... Oh, what is this? Advancements in vehicle technology. Use in future vehicles. Oh, they don't have the stainless going into future vehicles? Okay. So, you know, these are all things that could be presumably in the cyber cab in the future. But it is interesting to me because we don't... Yeah, they're not going to do the stainless steel anymore. The stainless steel is over. The stainless steel is over. At least after the CT model. That's interesting to me. That they're kind of... I mean, I don't know how I feel about that. Owning a Cybertruck, owning a CT, I don't know how I feel about that. Did they realize it's bad, right? Like, it kind of feels like they're sort of implying that it's bad now. I don't know. Maybe I'm looking at that a little weird. Okay, the Model Y refresh. That's the Semi. It's just a frame right now. That's the Mega Pack. That's actually going to build out. Yeah, where's Optimus talk? There should be some Optimus talk on here. Here's Cortex. Bro. What? Where's Optimus? Optimus. Oh, there it is. Progress on Optimus hardware and software continued in Q4, including the latest generation of hand, robust locomotive motion, and training on additional tasks, ahead of pilot production in 2025. Oh, okay, now it's pilot production. Okay. All right. I mean, honestly, like, it's not, like, horrible. And I think that's why the market is sort of like we knew. Oh, did Trump just comment on Powell? No way. I knew it was coming. Remember I said it during the live stream? I think like right after I was pitching the coupon code for the courses expiring in 2 days. I'm pretty sure I'm like, just wait. Trump will be talking about Powell soon. He'll call him. Let's see here. Because Jay Powell and the Fed failed to stop the problem of creating inflation, I will do it by unleashing American energy. The Fed has done a terrible job on banking regulation. If the Fed had spent less time on DEI, gender ideology, green energy, and fake climate change, inflation would have never been the problem. Oh, well, he hasn't called Powell yet. But, yeah, you're right. There is a comment. Thank you for pointing that out to me. I always find that very entertaining. So these newer vehicles, I'm just confused. Like, what is this newer vehicle that we keep talking about, or these newer models, right? I think that's really what I want here, is just give me some damn color on like how you're gonna pump the sales again. That's what would be very nice. So anyway, we've got a lot to look at here. We got Meta earnings coming out shortly. So we'll want to look at those. And let's see here. Okay, let's go. So the Tesla earnings call is unfortunately in like an hour. So it's going to take for frickin' ever to get to the earnings call. Which is fine. Yeah, it's in an hour from now. Whatever. But I'm still just waiting for Meta here. This is some fugazi here. Oh, what's going on? Here, let's listen to Dan Ives. This guy's permabull. So let's give him a listen. Oh, that's the wrong button.
Back, especially this week, hearing with DeepSeek and everything else. I think this is another one. I look at this numbers. I feel more bullish.
This numbers?
Because that ultimate AI number, I mean, that's really the lotto ticket right now if you own Microsoft.
This numbers.
I want to go back to Tesla for a second. How important is it, given everything that he is focused on right now, including in Washington, for Musk to be on the call? And when you do think about
Of
something
course he's
like
gonna be on the call.
robotaxi and autonomous driving, especially on a day where Waymo is announcing that it's going to expand its own taxis to 10 new cities, how much now hinges on that policy green light happening with this administration?
Yeah, I mean, look, it comes down to the deregulatory environment, the Musk bet on Trump, in terms of the bet for the ages. Now you need to see it in terms of the autonomous roadmap from a federal perspective. It is important. Obviously, Musk is on the call, talks about robo-taxi, talks about ultimately the timeline there, the view of autonomous, unsupervised FSD. Look, Morgan, these are really the things that are going to drive the stock. I mean, look, earnings itself are important in the next quarter or two, but I believe when you look out, I believe the AI autonomous story, that's worth $1 trillion alone. That's really going to be front and center on this call, along with what John asked about first half of the year, making sure, doubling down, these lower cost vehicles are out there. That's how you get to 20, 30% type of volume growth.
What lower cost car?
Given the fact that we have
That's what we're all waiting for, bro. Where's the lower cost car?
to start the week, we just got some comments from some of the CEOs, tech CEOs that John just spoke to with earnings. We're still
Tesla, though, it's almost recovered. It's almost flat.
Earlier this month actually had some interesting commentary on the Joe Rogan podcast about DeepSeek, how to think about what this does to drive down cost and who the beneficiaries are going to be, because there are going to be beneficiaries. Just thinking about some of the comments from ServiceNow, for example.
Yeah, and look, I mean, it comes down to that 65 billion. They're going to reiterate that probably 3 times in terms of CapEx for Meta and Zuck, 80 billion from Microsoft. Look, DeepSeek, it was a scare. And I continue to view it, it's bullish for the overall AI revolution, because going back to ServiceNow, Palantir, Salesforce.com, it's the use cases, it's software. That's not slowing it down in terms of what we saw in DeepSeek. And I think if you look at that, it was a shot across the bow. But ultimately, what we're going to look out in the next week or two in terms of earnings, the AI revolution is actually accelerating. And I think that is really going to be sort of a narrative that we hear even tonight.
Meta's teasing us. It's way late. What do you want to hear from them? Maybe even when it comes to...
It's because they're waiting for the settlement. They're waiting for Trump to sign the settlement. Meta to pay $25 million to settle lawsuit with Trump. Wow. Meta just settled a lawsuit for $25 million to Trump? No way. Meta settles a lawsuit with Trump for $25 million. That's probably why. Dude, Tesla's like almost 2% green now. Let's go. Look at this. Let's see here. Let's go. Picture. Look at that. It's like a straight rocket ship. Did Elon tweet something? Because I have not seen other updates here. It just sort of looks like you knocked out the sellers and it moves up. Let me see here. Elon. Did he say anything? Let's see here. Okay. What is this? Okay. No, nothing from Elon. Trying to see what's going on. It's up like 2.5% right now. No. No, I don't see anything. And I still don't see Meta earnings. Oh, well. Okay, cool. So let's see what else we have here. I mean, this is pretty good. Does that mean Microsoft recovered as well? Microsoft, yeah. That's actually pretty good, honestly. It went down there to 420 for a second. It's at like 437 now. Tesla's like rocketing right now. It's interesting. I have no idea why, but the numbers were a miss. But again, it's those. I think it's the affordable models that we want the color on. So who knows? Maybe there's some enthusiasm about that. I'm gonna write this down. So we got the reference to cost savings was. Reference to cost savings on manufacturing lines being lower was due to the, what's it called? Them basically using some of the conventional methods in conjunction with the new method. was from Doomberg on manufacturing, but the slide deck actually references, what's it called? Slide deck actually references combining conventional and new manufacturing methods to build new affordable vehicles. Tesla's had like a 10% swing here in the last like few minutes. It's actually really entertaining to watch. Let's see here. Tesla reveals Cortex. Well, we saw that. It was just sort of the name for it. We knew they had a lot of GPUs. Increase, let's write this down. Increased AI compute 400%. Let's see here. Margin X credits was 13.6%. We had, just sort of writing down some of the notes here. COGS were under $35,000 per vehicle. Okay. 16.3% margin including credits. Okay. Let's see here. What else did we see? We saw 692 mil in credits, down from 739 mil last quarter. Then we had preparations underway for the launch of new products in 2025, including more affordable models. Color on this would be useful. Like what kind of new model, right? Let's see here. Okay. They do expect a return to growth, but they don't seem to give a growth percentage. Where did you see that? I see you in the chat saying they were projecting some percentage growth of 20 to 30%. That's like Elon's old earnings call number, but I actually don't see that in the slide deck here. So I don't know what source you're reading, but that doesn't seem to be in the slide deck. Cheaper model meaning what? Exactly, yeah, that's what I'm wondering too. Let's see. Let's see. Very weak auto gross profit due to liquidation of inventory. Okay. Weak autos due to liquidation of inventory per Doomers. Per Doomberg. Clearing inventory helped with cash flow. Let's see here. Yeah, no mention of the Mexico plant. Still no Meta earnings. This is so weird. Huh. Okay. Okay. Bitcoin Systemi. Bitcoin Systemi, I don't think has, I don't know where you're getting these, but they did not forecast that. I mean, the only way they're doing that is they're taking what Elon said in a prior earnings call, and then they're merging together this with the cheaper model stock, which I agree, if they actually had new models, it'd probably do quite well. Bitcoin, let me see here what you're looking at. Bitcoin Systemi. I don't see it. Anyway, yeah, I don't know where they're getting that from. Oh well. Okay. Oh, they did a little summary. That's kind of nice. Let's see here. Little summary. Tesla on X has a little summary. I'll just sort of read through some of these here that we didn't already read. Okay, we expect the Model Y to become the best-selling car 2 years in a row. Let's see here. Also expecting to launch robo-taxi services in parts of the U.S. later this year. Oh, okay. Robo-taxi services later this year. Okay. Cybercab lineups are preparing for 2026. Semi-truck and cybercab ramps expected in 2026. Got it. Then, let's see here. Cortex. Holiday. Apple Watch support. I think that's pretty cool. Apple Watch support. 2.5K Cybertrucks worth 4680s, though stainless steel not included as in future vehicles. So I thought that was interesting. Mega Pack or Mega Factory. Shanghai completed in Q4. Then we have, let's see here, no mention on their tweet about new models, which is very interesting. No mention of new models on their tweet. Okay. They deployed supercharger stations. We're at 17% growth. 17% year-over-year growth on supercharger stations. Okay. All right. Just taking a peek around. Okay. Well, I don't see anything else on Tesla. I know we have the earnings call coming up here in a moment, and we still don't have Meta out. Let me see what the doomers are saying. Discounting could have hurt the P&L. Revenues per vehicle dropped below 40K. Gross margin now the lowest since at least 2018. Ouch. Okay. I'll write that down. So, let's see here. Okay. Lowest gross margin on vehicle since 2018. Okay, let me look at Microsoft here. Microsoft remains constraining cloud capacity. Let's write that down. Remains constrained in cloud. Let's see here. They still expect a CapEx boost. We kind of expected that. Still expect CapEx boost, but CapEx missed forecast by 25%. Wow. Wow, that's really interesting. Okay, how did NVIDIA move on that? Oh, NVIDIA's actually up after that, climbing once again to our lines. Still no Meta. This is very interesting. They must have delayed their earnings because of the lawsuit settlement talk. Okay. Let's see what else there is. Okay. Kathy Wood talking on Tesla. Okay, well, let's see what she has to say. Hold on. Just take just a sec. Can I do it? Yes. Okay. All right. We're going to have to do it a little differently. Fascinating. Okay. Stand by one sec. We're going to do... Let's see. Kathy's in a space talking, yapping about productivity. That will just take me 1 second to pull up. Start listening. Okay.
Which is the definition of productivity, is going up.
Let's go. Kathy's talking about deflationary
They
AI.
can cut
It's
prices
gonna take me
to
a sec
pass
to
along
get this. I
some
was not
of the
expecting
cost
this.
savings they're seeing. So we're really excited about what's going to go on out there. And if I didn't have to talk about this transition period, I would tell you short rates at this level, given the kind of acceleration in real growth that we expect in the next year or so, that they might be at the right level. Long rates, we think, have discounted the deficit too much, we think, and they're not focused on the disinflationary, if not deflationary ramifications of these productivity gains and the incredible cost declines associated with artificial intelligence. That was a bit of a ramble. I'm sorry. I'll be tighter with the next few questions.
Not a
Sorry.
problem at all. Love
Can you hear
listening
it
to your
now?
opinions and thoughts on this AI side of things, and especially
I
for
figured it
today
out.
with everything we're reading through that Tesla's recently released. Speaking of Tesla, we've got two of the top accounts in the world that talk about it, Sawyer and Omar, on here right now. Sawyer, do you have any thoughts or questions regarding Tesla that you would like to ask to Kathy?
Yeah, sure. Hey, Kathy, it was great to meet you and the ARC team at the Robotaxi unveiling.
Yes. Thank you, sir.
Yeah, so in regards to Tesla, in the last few months, I feel like there's been a narrative shift on Wall Street's part away from vehicle deliveries to sort of now more focusing on FSD, AI, and to a lesser degree, maybe Optimus. And you obviously talk to a lot of Wall Street types. In your experience and discussions, do you find that Wall Street has sort of finally woken up to the long-term potential of Tesla's FSD and the incredible progress that they made in the last 9 months, or do you sort of feel like they still have their heads in the sand?
I think what's happened very recently is...
Meta's out. Hold on really quick. Meta, sorry. That is, okay, Meta out. Ad revenue, 46.7. That's a beat on ad revenue. Family of apps beats. Reality Labs beats. Q1 revenue. Forecast was a little light. Forecast was a bit of a miss. Not providing a full year revenue outlook. Wow.
They're expert at the internal combustion engine. So I think there's a little bit of like, oh my gosh, I've been pretty wrong on this. There are some people who are stalwart there still, which is kind of unbelievable. But and now they have to face the prospect of modeling in autonomous. And I know I'm a little hamstrung here, but I know that Tesla started out after the report down 5% plus, and I don't know if it's still up 4% plus. But I do believe, the idea that Elon reinforced that Tesla will be scaling the Cybercab in 26 means production has to start this year. And I think they're all the work we're doing in our big ideas deck will be out next week, and in it you'll see, we can see Tesla getting down to in the next few years a 15,000. I should say this is a 5-year forecast, so $15,000 car. Again, this is nothing that traditional auto analysts can relate to. They've only seen their prices going up, the prices of the autos they follow going up, especially with more and more regulations over time. And they're not enjoying the cost declines associated with new technologies. So I think, and I hope have put out our autonomous model, and our 5-year model. We did that close to mid-year last year, and we stand by it. I hope more and more people are looking at it. They can look at it, and including the sell side analysts, and test if they don't like our assumptions. I think there are 40 variables we allow people or give them the opportunity to change and see how the price target changes from our 2600. So I think more and more people are starting to experiment with it, and there are some analysts out there, more on the tech side, who really do understand, and I think they are gaining more traction. I think the broadcasters, CNBC and others, are inviting them on more. And again, this is increasing the efficiency of this stock price.
Great question there, Sawyer. Appreciate that. And
Okay, just muting for a moment the discussion that's happening over there. So, a little bit of what we're getting right now is this. Hold on. Let me make sure I get this right. There we go. Okay, a little bit of what we're getting right now with Meta is you've got an ad beat of 2.47%, a miss at 2.5% on the midpoint for Q1 guide, and no annual guidance beyond that, but a 2.5% miss there. And the stock's only down about 0.7%. Tesla's still up like 3.5% after this. A lot of enthusiasm about a lower cost car, it seems to be, which I kind of would expect if we truly have one. Be nice to get some more color on it. Let's go back to the Cathie Wood discussion.
Great question. Our highest conviction AI names are, as you say, Tesla is the biggest AI project on earth. One of our highest conviction names. One of our highest conviction names. I would say if we're looking at other AI, and I am talking about generative AI applications here, we think the most profound applications, besides our Tesla, are in the healthcare space, and the convergence of sequencing technologies. I mean, I think people are astounded to learn that we have 37 trillion cells in our bodies. A lot of people focus on 20,000 genes, but we have 37 trillion cells in our bodies, and there's something called single cell sequencing out there right now, along with DNA, RNA, protein, methylation, metabolomics, a lot of other sequencing technologies. That is just the biggest data project in the world. It's bigger even than Tesla's, and Tesla's has been the biggest data project in the world thus far. So we're very excited there, and we think the inefficiencies in healthcare around the names that are going to be are capitalizing on the convergence of sequencing technologies, artificial intelligence, and CRISPR gene editing. Those inefficiencies today are as big, we believe, as the inefficiency in Tesla in 2018 and 19 when it was at its lows. And believe me, we are spitting in the wind at this. I mean, nobody in the healthcare space is giving this idea any oxygen at all. But our conviction is growing, and you'll see in our big ideas report next week how provocative this is. It's been the toughest space. It's been really tough in our flagship category fund, ARKK, to keep we call them multi-omics names, up in the 20 to 22% of the portfolio because they've so underperformed. But I think the I think the inefficiencies in that space are as big as the inefficiencies when we were taking on all the bears in Tesla in 2018 and 19. In terms of the commoditization of the space, well, I do think this is DeepSeek week, all right, and been getting a lot of questions here in Europe about it. What we believe is that DeepSeek is while everybody seems shocked by what they've just done, and we're not quite sure that they did it, but we'll see longer term. The model itself is as performant as OpenAI's o1. However, it purportedly cost somewhere between a tenth and a 20th the cost of the large language models that are evolving out there and approaching $100 million per model. So they say $6 million.
Meta's pumping?
Now, we don't know what they included in it or not. But if you look at our work over the last, really, we started following AI and modeling it in 2014, which is when we first bought NVIDIA at 40 cents a share. And as time has gone on, we've been able to discern the learning curve associated with AI. We use Wright's Law, and the learning curve is we've built it around the combination of hardware and software. And the metric was really hard to get. It's a metric of data per unit of computing power. And if you look at the cumulative doubling of that metric, for every cumulative doubling in that metric, costs have dropped 48%. But the very provocative, the aha moment for us was that the cumulative doubling in this space is happening in less than a year's time. So that AI training costs have been dropping 75% per year, and AI inference costs have been dropping 85 to 90% per year. So it's going to take us, if let's just say DeepSeek was on something here. Maybe they're a little bit off on that learning curve, but it's not going to take long because we're talking mostly about inference chips here. It's not going to take long for us to get to wherever they are now because costs are dropping 85, 90, 95% per year. It's really provocative. So that's the first thing I say. I think I think the nuance here, if you're thinking about NVIDIA, and I'll get back to the commoditization after this as well. The nuance here is this is a reasoning model, and it's much more reliant on inference chips. That's a more competitive category. You've got Grok, G-R-O-Q, out there, and they are commoditizing. If you want to talk commoditization, it is their mission to commoditize the inference chip space. They're doing another funding round right now, so we've been speaking with them, learning a lot. And yet Jonathan, who's the CEO, will be very quick to say, as he did upon the release of DeepSeek, he says, yes, we are focused on inference, and there are much lower margins. It is much more competitive space than the training space where the economics really are strong. And NVIDIA has had 85, 90% share of that market. So he's quick to say you need training, you need both sides. But what does seem to be happening is these models are going to tip the scales towards inference. There is a lot of competitive activity on the chip side from the hyperscalers themselves. And the reason for that is you've got NVIDIA's gross margins in the high 70s, and you've got the cloud companies' gross margins, we think, they don't give us all this information, somewhere in the low 50s to low 60s range. So these hyperscalers have a huge amount of cash to reinvest. And if one of their suppliers' margin structure is higher than their own, well, they have a big incentive to invest there. And they all are. Amazon has Trainium and Inferentia. Google has the TPU. Microsoft and Meta are designing their own chips,
tensor
but they're
processing
also
unit.
helping
Also,
AMD with the software side.
just looked at Meta. Meta has a 14% growth in price per ad year over year.
Is able to handle all of the, I don't know how many frameworks there are now out there. It was 13. I think it might be 15 now. Whereas most of the others are much more specialized to just one or two frameworks. Well, if you think about that too, what is AI especially good at doing? It's coding. And so if there are 13, 15 different frameworks out there, and we are moved, if you look at the SWE benchmark, and for those of you who are watching this, coding agents now can be given a job and complete more than 75% of it. And if you're using Replit, we're hearing sometimes 80% and more without human intervention. So won't it be a little easier now to convert to all of those frameworks? I'm probably throwing too much at you, but there's just so much going on in this space. And in terms of the cost coming down for the users of AI, this is amazing, amazing. Well, I know that the big controversy this week has been, wait a minute, and this may be changing now. I don't know if Meta's out yet. It wasn't when we were starting this call. But, before DeepSeek, Zuckerberg came out and said, yep, we're going to spend $60 to $65 billion in CapEx towards data centers, AI, everything, including power. Microsoft, I think it was 80 billion, if I'm not mistaken. So these are big, big jumps. And they may have committed to GPUs, which, I always look at a space. And when I see double ordering, triple ordering, a frenzy, no one can get enough, I usually believe there's going to be a big inventory problem out there somewhere. Now, DeepSeek, if what they're saying is real, and if we are now doing more on the inference side, maybe there will be too much in the form of inventory for NVIDIA. This all remains to be seen. We just have to learn more about DeepSeek. And one other thing I'll say, I saw Microsoft came out and trying to discern what the currency impact was. But, Microsoft's revenue growth, from what I can see, decelerated. I think it's gone from 17% to 16%, and to 12% is what I saw. Might be with currency a little higher when you adjust out for currency, a little higher, and that's the true underlying growth. Let's say 13%, but that's a slowdown. And in the work that we've done on the software space, we think that software growth should accelerate. All parts of the tech stack, the growth rate should accelerate. Why is Microsoft's growth slowing down? What is that? Again, we're going to be looking, and ServiceNow apparently, and again, I'm just catching snippets, but they're going from a subscription to more of a usage-based model, I think. And so they're cutting their revenue growth. The revenue growth is decelerating. And, maybe it's going to take a while for the growth to turn back around, but we need to investigate what's going on here.
I love it. Kathy, I know it's getting late over there by you, and I really
right.
appreciate you making the time to come and speak with us. We're going to
You
take
gonna ask
one last
anything
question, if that's okay, and then we'll wrap
No.
up with you.
Sure. Great.
Amazing. Stock Talk, I'll turn it over to you.
Yeah, perfect. Thanks for being with us and appreciate all your commentary as always. I was actually going to ask you about your thoughts on inference versus training and how that would affect compute supply and investment in compute, but you sort of already answered that in your initial question. So I'll ask you about something else that I've always kind of been curious about your opinion on. I know, ARC and your research team have been very involved in the clean energy space, obviously via Tesla, but via other stocks as well, especially during the SPAC era. What I haven't heard you talk a lot about is nuclear energy, and I'm very curious about your thoughts on the role that nuclear might play in this next generation of technology, whether or not we think this data center theme might be as big as some people do. What are your kind of thoughts on where you see nuclear energy? What exposures ARC might be looking to have to that theme, if any?
Yes.
Yeah,
They usually say an electron's electron, and they don't love it.
Specialized portfolios, ARKQ, which Tesla is its largest position. The name of that fund is Autonomous Technology and Robotics. So in that fund, we have been buying nuclear names. In fact, we got into Cameco early last year. Let's see, we got into Oklo when it had been really beaten up, and got to meet that management, learn about their small modular reactors, and so we've done pretty well trading that one. BWXT, the old Westinghouse, we have initiated a position. For it to migrate into the bigger funds, it was starting to get so hyped that we said, okay, we have a choice between buying a genomics name that's getting trashed or a hyped nuclear name because of data centers. And so we've been focused more on the multi-omics genomics space, but we have very high hopes for nuclear. In our big ideas next week, you will see a lot more on nuclear. Sam Corris and Daniel McGuire have been spending a lot of time on it. And one of the most provocative things about nuclear is regulation arrested that technology cycle. The regulation took place in 1974 in was Japan and the US. One of them was 74, one was 78. And
Oh, sorry. Thank you. So I was just going to do a little bit of a recap here. I think it'd be a little crazy to think that we should expect to see any kind of CapEx reductions in actual printed numbers from Microsoft or Meta, but it's possible that we end up getting something from them in the next in the earnings calls. We'll see. I don't know about that. Again, I think they'll talk earnings, efficiency, EPS, and otherwise. As far as Tesla's earnings call starts in about 29 minutes. So excited about that. And yeah, buckle up. It's going to be fun. Look at this. NVIDIA right now, 1.65%. Starbucks holding on to flat after an 8% day. Pretty good. Bitcoin 103.6. Salesforce down a little bit, probably after ServiceNow's move, down about 8.6%. Microsoft down about 1.7. Tesla's still up about 3.3, and Meta's also up just about 0.5%. All right, let's go back to what Kathy's saying for the next little a few moments here. I'll grab a snack really quickly as well.
We do believe that this is the rebirth of the nuclear age. It had to be jump-started by the data center demands, but we think as more and more analysts and environmentalists study what this technology is all about, they'll see how wayward the last 50 years have been. Government regulation is a menace if it is not for our national security and our safety. They might have thought it was for our safety, but they were regulating. They were wrong. Sure, we had the nuclear accidents, and that was terrible. But they were extrapolating that into a monster, which we do not believe will exist. And again, we're very optimistic.
Beautiful. Kathy, I always appreciate the passion and the vigor with which you speak, combined with the detailed analytics and the experience that you come to the table with. Thank you so much for, on a travel day, late at night, over in Europe, Germany, taking the time to come speak with us. We really appreciate it. And I know that we're hoping with your team to set up a space maybe in a month or two to talk on the venture side of it.
All right. So let's listen in over here.
Steve, thank you. Steve Kovac in San Francisco for us. It does seem like the weak Azure number is front and center, at least right now, until they talk about guidance for CapEx on the call.
Yeah, but 1/10 of, I mean, it's not a miss. I mean, it's basically in line. And I look at this and say revenues up 12% year over year. Margins were better. I think what it comes down to is valuation. You're talking about a stock that's probably trading around 30, 31 times next year's numbers. And in an environment now where valuation is front and center, given what we heard on Monday, that's concerning. I don't think you're going to sell the stock down to 415 or so, but it's one of those quarters where we're going to continue to go sideways. By the way, Microsoft made its all-time high in July.
Yeah.
The broader market's been doing extraordinarily well since then. It's been going sideways to slightly lower ever since.
Yeah, and I'm not so concerned about, coming in line at 31% versus the estimate, like I just said, of 31.1. It really is that deceleration from 34% last quarter to 31% this quarter. And then you have to start asking yourself, okay, well, they have this really cozy relationship with OpenAI. A big part of that deal over the last 2 years is OpenAI's use of their cloud infrastructure. And so if that relationship is being strained in everywhere you look.
Because of Stargate.
Because of Stargate, because of a whole host of other things. I mean, OpenAI, I think quietly has been complaining about either their capacity, that sort of thing. So at the end of the day, I mean, the Microsoft story was an early beneficiary.
All right, so let's do a little chat in here. Let's see what we got. So we're going to have the earnings call for, what's it called? A Tesla here in about 25 minutes. I think we can probably jump into let me see if the Meta call is underway, because maybe what we can do is we can watch a little bit of Meta, and that probably isn't a bad idea. And then we'll be able to jump on over into Tesla when Tesla starts soon. So I'll give that just a second here. We'll pull that up, and we'll see what we can get from them. Should be entertaining. Meta earnings call. Let's see here. Okay. Yeah. Okie dokie. Benzinga is streaming it. So I'll pop on over to them for just a moment here.
Our Ray-Ban Meta AI glasses are a real hit, and this will be the year when we understand the trajectory for AI glasses as a category. Many breakout products in the history of consumer electronics have sold 5 to 10 million units in their third generation. This will be a defining year that determines if we're on a path towards many hundreds of millions and eventually billions of AI glasses, and glasses being the next computing platform like we've been talking about for some time, or if this is just going to be a longer grind. But it's great overall to see people recognizing that these glasses are the perfect form factor for AI, as well as just great stylish glasses. These are all big investments, especially the hundreds of billions of dollars that we will invest in AI infrastructure over the long term. I announced last week that we expect to bring online almost a gigawatt of capacity this year, and we're building a 2 gigawatt and potentially bigger AI data center that is so big that it'll cover a significant part of Manhattan if it were placed there. we're planning to fund all of this by, at the same time, investing aggressively in initiatives that use these AI advances to increase revenue growth. And we've put together a plan that will hopefully accelerate the pace of these initiatives over the next few years. That's what a lot of our new headcount growth is going towards. And how well we execute on this will also determine our financial trajectory over the next few years. There are a number of other important product trends related to our family of apps that I think we're going to know more about this year as well. We're going to learn what's going to happen with TikTok. And regardless of that, I expect Reels on Instagram and Facebook to continue growing. I expect Threads to continue on its trajectory to become the leading discussion platform and eventually reach a billion people over the next several years. Threads now has more than 320 million monthly actives and has been adding more than 1 million signups per day. I expect WhatsApp to continue gaining share and making progress towards becoming the leading messaging platform in the US, like it is in a lot of the rest of the world. WhatsApp now has more than 100 million monthly actives in the US. Facebook is used by more than 3 billion monthly actives, and we're focused on growing its cultural influence. And I'm excited this year to get back to
700.
some OG
Wow,
Facebook.
Meta.
All right, so this is also going to be a pivotal year for the metaverse. The number of people using Quest and Horizon has been steadily growing. And this is a year when a number of the long-term investments that we've been working on that will make the metaverse more visually stunning and inspiring will really start to land. So I think we're going to know a lot more about Horizon's trajectory by the end of this year. This is also going to be a big year for redefining our relationship with governments. We now have a U.S. administration that is proud of our leading companies, prioritizes American technology winning, and that will defend our values and interests abroad. And I am optimistic about the progress and innovation that this can unlock. So this is going to be a big year. I think that this is the most exciting and dynamic that I have ever seen our industry. Between AI, glasses, massive infrastructure projects, doing a bunch of work to try to accelerate our business and building the future of social media, we have a lot to do. And I think we're going to build some awesome things that shape the future of human connection. As always, I am grateful for everyone who's on this journey with us. Thank you. Here's Susan.
Thanks, Mark, and good afternoon, everyone. Let's begin with our consolidated results. All comparisons are on a year-over-year basis, unless otherwise noted. Q4 total revenue was $48.4 billion, up 21% on both a reported and constant currency basis. Q4 total expenses were $25 billion, up 5% compared to last year. Before I cover the specific cost lines, I would note that our fourth quarter expense growth rate reflects a 13 percentage point favorable impact from legal accrual reductions in Q4 and lower year-over-year restructuring costs. In terms of the specific line items, cost of revenue increased 15%, driven mostly by higher infrastructure costs. R&D increased 16%, primarily driven by higher employee compensation and infrastructure costs, which were partially offset by lower restructuring costs. Marketing and sales were approximately flat year-over-year. G&A decreased 67%, driven mostly by lower legal-related expenses due to a $1.55 billion reduction in legal accruals related to certain legal proceedings. We ended the year with over 74,000 employees, up 10% year-over-year, with growth primarily driven by hiring in priority areas of monetization, infrastructure, generative AI, Reality Labs, as well as regulation and compliance. Fourth quarter operating income was $23.4 billion, representing a 48% operating margin. Our tax rate for the quarter was 12%. Net income was $20.8 billion, or $8.02 per share. Capital expenditures, including principal payments on finance leases, were $14.8 billion, driven by investments in servers, data centers, and network infrastructure. Free cash flow was $13.2 billion. We paid $1.3 billion in dividends to shareholders, ending the year with $77.8 billion in cash and marketable securities and $28.8 billion in debt. Moving now to our segment results. I'll begin with our Family of Apps segment. Our community across the Family of Apps continues to grow, and we estimate more than 3.3 billion people used at least one of our Family of Apps on a daily basis in December. Q4 total Family of Apps revenue was $47.3 billion, up 21% year over year. And Q4 Family of Apps ad revenue was $46.8 billion, up 21% on both a reported and constant currency basis. Within ad revenue, the online commerce vertical was the largest contributor to year-over-year growth. On a user geography basis, ad revenue growth was strongest in rest of world at 27%, followed by Asia Pacific and Europe at 23% and 22% respectively. North America grew 18%. In Q4, the total number of ad impressions served across our services increased 6%, and the average price per ad increased 14%. Impression growth was mainly driven by Asia Pacific. Pricing growth benefited from increased advertiser demand, in part driven by improved ad performance. This was partially offset by impression growth, particularly from lower monetizing regions and surfaces. Family of Apps other revenue was $519 million, up 55%, driven primarily by business messaging revenue growth from our WhatsApp business platform. We continue to direct the majority of our investments toward the development and operation of our Family of Apps. In Q4, Family of Apps expenses were $19 billion, representing 76% of our overall expenses. Family of Apps expenses were up 5%, primarily due to growth in infrastructure costs and employee compensation, which were partially offset by lower legal-related expenses. Family of Apps operating income was $28.3 billion, representing a 60% operating margin. Within our Reality Labs segment, Q4 revenue was $1.1 billion, driven by hardware sales and up 1% year over year. Reality Labs expenses were $6 billion, up 6% year over year, driven primarily by higher infrastructure costs and employee compensation, partially offset by lower restructuring costs. Reality Labs operating loss was $5 billion. Turning now to the business outlook. There are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community and our effectiveness at monetizing that engagement over time. On the first, daily actives continue to grow across Facebook, Instagram, and WhatsApp year over year, both globally and in the United States. In Q4, global video time grew at double-digit percentages year over year on Instagram, and we're seeing particular strength in the US on Facebook, where video time spent was also up double-digit rates year over year. We see continued opportunities to drive video growth in 2025 through ongoing optimizations to our ranking systems. We're also making several product bets that are focused on setting up our platforms for longer-term success. Creators are one of our central focuses. On Instagram, we continue to prioritize original posts and recommendations to help smaller creators get discovered. We also want to ensure creators have a place to experiment with their content, so we introduced a new feature in Q4 that allows creators to first share a reel with people who don't follow them. This allows them to test content and see what performs best before deciding to share it with their followers, and also helps introduce them to entirely new audiences. Creative tools is another area we're investing in. In the coming weeks, we'll launch a new standalone app called Edits that provides a full suite of creative tools to make it easier for creators to make great reels on their phone. Another focus is making it easier for people to connect over content. Reels are already reshared over 4.5 billion times a day, and we've been introducing more features that bring together the social and entertainment aspects of Instagram. In the US, we recently launched a new destination in Reels that consists of content your friends have left a note on or liked. We're seeing very positive early results, and we'll look to expand this globally in the coming months. On Threads, we made tremendous progress in 2024, and our focus this year is establishing Threads as the place people come to keep up with what they care about. We're making a number of updates to our recommendation systems to prioritize more recent posts, surface content from top creators, and ensure people see more of the content from accounts they follow. We will also continue improving custom feeds so people can build personalized feeds on topics they're interested in. Finally, Meta AI usage continues to scale with more than 700 million monthly actives. We're now introducing updates that will enable Meta AI to deliver more personalized and relevant responses by remembering certain details from people's prior queries and considering what they engage with on Facebook and Instagram to develop better intuition for their interests and preferences. Now to the second driver of our revenue performance, increasing monetization efficiency. The first part of this work is optimizing the level of ads with an organic engagement. We continue to grow supply on lower monetizing surfaces like video, while optimizing ad supply on each of our surfaces to deliver ads at the time and place they will be most relevant to people. For example, we are continuing to better including the optimal locations in the depth of someone's feed to introduce ad supply when it's most optimal for the user and revenue. This is enabling efficient supply growth. Longer term, we also see impression growth opportunities on unmonetized surfaces like Threads, which we are beginning to test ads on this quarter. We expect the introduction of ads on Threads will be gradual and don't anticipate it being a meaningful driver of overall impression or revenue growth in 2025. The second part of increasing monetization efficiency is improving marketing performance. The ongoing enhancements to our ads ranking systems are an important driver of this work. In the second half of 2024, we introduced an innovative new machine learning system in partnership with NVIDIA called Andromeda. This more efficient system enabled a 10,000 times increase in the complexity of models we use for ads retrieval, which is the part of the ranking process where we narrow down a pool of tens of millions of ads to the few thousand we consider showing someone. The increase in model complexity is enabling us to run far more sophisticated prediction models to better personalize which ads we show someone. This has driven an 8% increase in the quality of ads that people see on objectives we've tested. Andromeda's ability to efficiently process larger volumes of ads also positions us well for the future as advertisers use our generative AI tools to create and test more ads. Another way we're delivering value for advertisers is through increased automation of their ad campaigns with Advantage Plus. Adoption of Advantage Plus shopping campaigns continues to scale, with revenue surpassing a $20 billion annual run rate and growing 70% year over year in Q4. Given the strong performance and interest we're seeing in Advantage Plus shopping and our other end-to-end solutions, we're testing a new streamlined campaign creation flow so advertisers no longer need to choose between running a manual or Advantage Plus sales or app campaign. In this new setup, all campaigns optimizing for sales, app, or lead objectives will have Advantage Plus turned on from the beginning. This will allow more advertisers to take advantage of the performance Advantage Plus offers, while still having the ability to further customize aspects of their campaigns.
Nope, guess it's not AI.
We plan to expand to more advertisers in the coming months before fully rolling it out later in the year. Advantage Plus Creative is another area where we're seeing momentum. More than 4 million advertisers are now using at least one of our generative AI ad creative tools, up from 1 million 6 months ago. There has been significant early adoption of our first video generation tool that we rolled out in October, Image Animation, with hundreds of thousands of advertisers already using it monthly. Next, I would like to discuss our approach to capital allocation. Our primary focus remains investing capital back into the business, with infrastructure and talent being our top priorities. On the first, we expect compute will be central to many of the opportunities we're pursuing as we advance the capabilities of Llama, drive increased usage of generative AI products and features across our platform, and fuel core ads and organic engagement initiatives. We're working to meet the growing capacity needs for these services by both scaling our infrastructure footprint and increasing the efficiency of our workloads. Another way we're pursuing efficiencies is by extending the useful lives of our servers and associated networking equipment. Our expectation going forward is that we'll be able to use both our non-AI and AI servers for a longer period of time before replacing them, which we estimate will be approximately 5.5 years. This will deliver savings in annual CapEx and reducing depreciation expense, which is already included in our guidance. Finally, we're pursuing cost efficiencies by deploying our custom MTIA silicon in areas where we can achieve a lower cost of compute by optimizing the chip to our unique workloads. In 2024, we started deploying MTIA to our ranking and recommendation inference workloads for ads and organic content. We expect to further ramp adoption of MTIA for these use cases throughout 2025 before extending our custom silicon efforts to training workloads for ranking and recommendations next year. From a hiring standpoint, our focus continues to be on adding technical talent to support our strategic priorities. In the fourth quarter, nearly 90% of our year-over-year headcount growth was within the R&D function. The remaining growth was primarily in cost of revenue as we added infrastructure headcount to support our data center operations. In 2025, we expect headcount growth will continue to be primarily driven by technical roles across our priority initiatives within infrastructure, monetization, Reality Labs, generative AI, as well as regulation and compliance. We anticipate headcount growth in our business functions will remain relatively limited. To achieve our ambitions in these areas, we will need to continue executing at a rapid pace. We're supporting this by building tools to help our engineering base be more productive. As part of our efficiency focus over the past 2 years, we've made significant improvements in our internal processes and developer tools and introduced new tools like our AI-powered coding assistant, which is helping our engineers write code more quickly. Looking forward, we expect that the continuous advancements in Llama's coding capabilities will provide even greater leverage to our engineers, and we are focused on expanding its capabilities to not only assist our engineers in writing and reviewing our code, but to also begin generating code changes to automate tool updates and improve the quality of our code base. Finally, we expect our strong financial position will enable us to support these investments while continuing to return capital to shareholders through share repurchases and dividends. Moving to our financial outlook, we expect first quarter total revenue to be in the range of $39.5 to $41.8 billion. This reflects 8 to 15% year-over-year growth, or 11 to 18% growth on a constant currency basis, as our guidance assumes foreign currency is an approximately 3% headwind to year-over-year total revenue growth based on current exchange rates. This also reflects the effect of lapping leap day in the first quarter of 2024. While we are not providing a full year 2025 revenue outlook, we expect the investments we're making in our core business this year will give us an opportunity to continue delivering strong revenue growth throughout 2025. Turning now to the expense outlook, we expect full year 2025 total expenses to be in the range of $114 to $119 billion. We expect the single largest driver of expense growth in 2025 to be infrastructure costs driven by higher operating expenses and depreciation. We expect employee compensation to be the second largest factor as we add technical talent in the priority areas that I referenced earlier. Turning now to the CapEx outlook, we expect our full year 2025 capital expenses will be in the range of $60 to $65 billion. We expect CapEx growth in 2025 will be driven by increased investment to support both our generative AI efforts and our core business. The majority of our CapEx in 2025 will continue to be directed towards our core business. On to tax. Absent any changes to our tax landscape, we expect our full year 2025 tax rate to be in the range of 12 to 15%. In addition, we continue to monitor an active regulatory landscape, including legal and regulatory headwinds in the EU and the US that could significantly impact our business and our financial results. In closing, this was a good year for our company, with investments across our priority areas delivering strong business performance and innovative new products for our community. We have a compelling set of opportunities to invest in this year, which we expect will help us drive continued strong growth and develop transformative technologies that shape the future of our company and of the industry. With that, Krista, let's open up the call for questions.
Thank you. We will now open the lines for a question and answer session. Question?
It's loud. Let me fix that really quickly. We're going to go over to Elon in just a moment as well.
Please pick up your handset before asking your question to ensure clarity. If you are streaming today's call, please mute your computer speakers. And our first question comes from the line of Brian Nowak with Morgan Stanley. Please
Ask
go
about
ahead.
DeepSeek.
Thanks for taking my questions. Mark, you sound we appreciate all the excitement about this year and all of the innovation to come. I know there's a lot of announcements throughout the course of the year, but wonder if you could just share a few sort of high-level examples of your vision on new potential use cases and offerings that could drive utility for your users and value for your advertisers as you sort of think about Llama 4 and Meta AI changing throughout 2025. And then the second one on custom silicon, maybe a question for either of you, just any learnings on the difference between your custom silicon and
all right, I don't think we're going to get much on that, so I'm going to have to jump on over for a moment just to get the Tesla call prepped here, since that's, they're going to start the music now, but it doesn't start yet for another minute or so, and we'll go ahead and get that pulled up, and this is the entertaining part, so, all right, actually, let's see here, I hear their sound yet? Let's see. Okay, one sec. They just started streaming this. In fact, it still says 0 views. That's funny. They should still be on the music, but let me see. 1 second here. Oh, yeah. Definitely still on the music. All right. So, some interesting stuff there from Meta. Talk about efficiency was definitely incorporated in there, but nothing super groundbreaking. Keep an eye on this, obviously. Let's see what, let's see here. 48% operating margins were amazing. Ad revenue growth at 27% in the rest of the world. This is a business that's printing money. They keep going. They keep printing. They're doing great. Yeah, still music there on the Tesla one. So, yeah. All right. Kind of excited to see what we got here. Still music. And obviously no CapEx changes yet. I'd like to hear what they end up saying about DeepSeek, but obviously right as we got into Q&A, we're jumping on over to see what's going on over at Tesla. Well, give it a couple minutes here. What else do we have there? Glasses. Y'all think you're going to wear Meta glasses? Kind of interested in the long term, where that ends up going. I could see it. So it has to be lightweight, though. You know, so we learned from the iPhone ones, or the Apple ones. If they're too heavy, it's not going to work well. Still waiting. Okay. It is common, by the way, for them not to give annual guidance when it comes to Meta. So that's not horribly common or uncommon. Still waiting. I don't know that they sold Bitcoin. I saw a note that they had mark to market in Bitcoin. Mark to market doesn't mean you sold. Mark to market, yeah, it does mean they certainly propped their EPS with that. But I see what you're saying. Yeah. Okay. So they're usually like 2 or 3 minutes late. Yeah. 3 minutes in. I feel like the Tesla earnings calls are like, you know, Elon shows up to the Zoom call like 3 minutes later. He's like, oh, sorry guys, sorry, I was just finishing Diablo. All right, what are we doing? The earnings call, Elon. Oh, yeah. So I think Tesla's going to be the most valuable company in the world by an order of magnitude. Who are they fooling? Yeah, there's also some gamification that you always that you can get in some of the numbers as well. But you're right. Yeah, there's certainly a game being played a little bit there. But a lot of companies do that. It's like, oh, we had a bad quarter. Let's buffer it with.
Good afternoon, everyone, and welcome to Tesla's fourth quarter 2024 Q&A webcast. My name is Travis Axelrod, the head of investor relations here at Tesla.
Hold on, you know
what?
what?
I'm joined today by Elon Musk.
Let me quickly get the what's it called up? The sticks, so we can see those as well. Yeah, I think that's going to be a good idea. So we'll sort of leave this open as they do their little disclaimer read really quickly. Put that in the background. There we go.
On our predictions and expectations as of today.
Wow,
Actual
Meta.
events or results could differ materially due to a number of risks and uncertainties,
707.
including those mentioned in our most recent filings with the SEC.
Tesla.
During the question and answer portion of today's call, please limit yourself to one question and one follow-up. Please use the raise hand button to join the question queue. Before we jump into Q&A, Elon has some opening remarks. Elon?
Thank you. So in summary, in Q4, we set a record and delivered vehicles at an annualized rate of nearly 2 million a year. So congratulations to the Tesla team on excellent work achieving record production and deliveries. Model Y was the best-selling vehicle of any kind for 2024. That's worth noting. Not just the best electric vehicle, the best vehicle of any kind on Earth, number one, was Model Y. We're staying focused on maximizing volumes and obviously doubling down, or I don't know what. Really, I was going to say doubling down on autonomy, but really it's like autonomy is like 10xing things, frankly. Doubling is not even enough. We made many critical investments in 2024 in manufacturing AI and robotics that will bear immense fruit in the future. Immense. Like it's, in fact, to such a scale that it is difficult to comprehend. And I've said this before, and I'll stand by it. I see a path. I'm not saying it's an easy path, but I see a path
Here it is.
to Tesla being the most valuable company in the world by far. Not even close. Like maybe several times more than. I mean, there is a path where Tesla is worth more than the next top 5 companies combined. There's a path to that. I mean, I think it's like an incredibly, it's like a difficult path, but it is an achievable path. And that is overwhelmingly due to autonomous vehicles and autonomous humanoid robots. So our focus is actually building towards that. And that's what we're laying the ground. We laid the groundwork for that in 2024. We'll continue to lay the groundwork for that in 2025. In fact, more than lay the groundwork, actually, so we'll be building the structure. We're building the manufacturing lines, I'd like setting up for what I think will be an epic 2026 and a ridiculous 27 and 28. Ridiculously good. That is my prediction. as yet, very few people understand the value of full self-driving and our ability to monetize the fleet. I've some of these things I've said for quite a long time, and I know people have said, well, Elon's the boy who cried wolf like several times, but I'm telling you, there's a damn wolf this time, and you can drive it. In fact, it can drive you. It's a self-driving wolf. For a lot of people, they're like their experience of Tesla autonomy is like, if it's even a year old, if it's even 2 years old, it's like meeting someone when they're like a toddler and thinking that they're going to be a toddler forever. But obviously not going to be a toddler forever. They grow up. but if their last experience was like, oh, FSD was a toddler, it's like, well, it's grown up now. Have you seen it? It's like walks and talks. That's really what we've got. And it's difficult for people to understand this because human intuition is linear, as opposed to what we're seeing is exponential progress. So that's why my number one recommendation for anyone who doubts is simply try it. Have you tried it? When's the last time you tried it? And the only people who are skeptical are those who have not tried it. So, a passenger car typically has only about 10 hours of utility per week out of 168. A very small percentage. Once that car is autonomous, my rough estimate is that it is in use for at least a third of the hours of the week. So call it 50, maybe 55 hours of the week. And it can be used for both cargo delivery and people delivery. So even, let's say, people are asleep, but you can deliver packages in the middle of the night or resupply restaurants or whatever the case may be, whatever people need at all hours of the day or night. That same asset, the thing that is these things that already exist with no incremental cost change, just a software update, now have 5 times or more the utility than they currently have. I think this will be the largest asset value increase in human history. Maybe there's something bigger, but I just don't know what it is. And so people who look in the rearview mirror are looking for past precedent, except I don't think there is one. So, but the reality of autonomy is upon us. And I repeat my advice: try driving the car, or let it drive you. So now it works very well in the U.S., but of course it will over time work just as well everywhere else. So we're working hard to grow our annual volumes. Our constraint this year, our current constraint is battery packs this year, but we're working on addressing that constraint. And I think we will make progress on addressing that constraint. And then things are really going to go ballistic next year, and really ballistic in 27 and 28. So, So a bit more on full self-driving. Our Q4 vehicle safety report shows continued year-over-year improvement in safety for vehicles. So the safety numbers, if somebody has supervised full self-driving turned on or not, the safety differences are gigantic. And people have seen the immense improvement with version 13 and with incremental versions in version 13. And then version 14 is going to be yet another step beyond that is very significant. We launched the Cortex training cluster at Gigafactory Austin, which was a significant contributor to FSD advancement. And we continue to invest in training infrastructure at our Texas headquarters. So the training needs for Optimus humanoid robot are probably at least ultimately 10x what's needed for the car, at least to get to the full range of useful roles. You can say, like, how many different roles are there for a humanoid robot versus a car? humanoid robot has probably 1,000 times more uses.
Is this why we didn't hear much about
complex
Optimus
things
in the deck?
in a car. That doesn't mean the training scales by 1,000, but it's probably 10x. Now you can do this progressively, so it doesn't mean like Tesla's going to spend like $500 billion in training compute,
Right.
because we will obviously train Optimus to do enough tasks to match the output of Optimus robots. But obviously the cost of training is dropping dramatically with time. So, but it is like it's one of those things where I think long-term Optimus will be. Optimus has the potential to be north of $10 trillion in revenue. Like it's really bananas. So then you can obviously afford a lot of training compute in that situation.
Oh no.
In fact, even $500 billion of training compute in that situation would be quite a good deal. Yeah. The future is going to be incredibly different from the past, that's for sure. We live at this unbelievable inflection point in human history. So, yeah. So, the proof is in the pudding. So we're going to be launching unsupervised full self-driving as a paid service in Austin in June. So
wow, June.
Talked with the team. We feel confident in being able to do an initial launch of unsupervised, no one in the car, full self-driving in Austin in June. We already have Teslas operating autonomously, unsupervised full self-driving at our factory in Fremont, and we'll soon be doing that at our factory in Texas. So thousands of cars every day are driving with no one in them at our Fremont factory in California. They will soon be doing that in Austin and then elsewhere in the world, the rest of our factories, which is pretty cool. And the cars aren't just driving to exactly the same spot, because obviously it all wouldn't collide at the same spot. The cars are actually programmed with what lane they need to park into to be picked up for delivery. So they drive from the factory end of line to their destination parking spot to be picked up for delivery to customers. And they're doing this reliably every day, thousands of times a day. It's pretty cool. Like I said, the Teslas will be in the wild with no one in them in June in Austin. So what I'm saying is, this is not some far-off mythical situation. It's literally, 5-6 months away, 5 months away, type of thing. And while we're putting our toe in the water gently at first, just to make sure everything's cool, our solution is a generalized AI solution. It does not require high precision maps of a locality. So we just want to be cautious. It's not that it doesn't work beyond Austin. In fact, it does. We just want to put a toe in the water, make sure everything is okay, then put a few more toes in the water, then put a foot in the water, with safety of the general public and those in the car as our top priority. With regard to Optimus, obviously I'm making these revenue predictions that sound absolutely insane. I realize that, but they are. I think they will prove to be accurate. Yeah. Now with Optimus, there's a lot of uncertainty on the exact timing, because it's not like a train arriving at the station for Optimus. We are designing the train and the station and in real time while also building the tracks. And so they're like, people should say, why didn't the train arrive exactly at 12:05? I'm like, we're literally designing the train and the tracks in the station in real time so you're like, how can we predict this thing with absolute precision? It's impossible. The normal internal plan calls for roughly 10,000 Optimus robots to be built this year. Will we succeed in building 10,000 exactly by the end of December this year? Probably not. But will we succeed in making several thousand? Yes, I think we will. Will those several thousand Optimus robots be doing useful things by the end of the year? Yes, I'm confident they will do useful things. The Optimus in use at the Tesla factories, production design 1, will inform what we change for production design 2, which we expect to launch next year. And our goal is to ramp Optimus production faster than maybe anything's ever been ramped, meaning like aspirationally an order of magnitude ramp per year. Now, if we aspire to an order of magnitude ramp per year, perhaps we only end up with a half order of magnitude per year. But that's the kind of growth that we're talking about. It doesn't take very many years before, we're making 100 million of these things a year. If you go up by, let's say, a factor, by 5x per year. It's insane. Insane. Not 50%. 500%. So, these are big growth numbers. But we do need to. This is an entirely new supply chain. It is entirely new technology. There's nothing off the shelf to use. We tried desperately with Optimus to use any existing motors, any actuators, sensors. Nothing worked for a humanoid robot at any price. We had to design everything from physics first principles to work for a humanoid robot, and with the most sophisticated hand that has ever been made before, by far. And Optimus will be able to play the piano, and be able to thread a needle. I mean, this is the level of precision no one has been able to achieve, and so it's really something special. So my prediction long term is that Optimus will be overwhelmingly the value of the company. Regarding energy, back to Earth. Earth to Elon. Can you come back here for a minute? Okay, back to Earth. Energy storage is a big deal, and will become. It's already super important. Will become incredibly important in the future, and it is something that enables far greater energy output to the grid than is currently possible, because the grids are the vast majority of the grid has no energy storage capability, so they have to design the power plants for very high peaks, and assuming that there's no energy storage. Once you have grid energy storage and home-based energy storage, the actual total energy output per year of the grid is dramatically greater than people think. Maybe it's at least double. This will drive the demand of stationary battery packs, and especially the grid scale ones, to insane, basically as much demand as we could possibly make. We have our second factory, which is in Shanghai, that's starting operation, and we're building a third factory. So we're trying to ramp output of stationary battery storage as quickly as possible. Now, there is a challenge here where we have to be careful that we're not robbing from one pocket to take to another pocket, because for a given gigawatt hours per year of cell output, we have to say, does it go into stationary applications or mobile applications? It can't go into both. So we have to make that trade-off. But overall, the demand for total gigawatt hours of batteries, whether mobile or stationary, that will grow to in a very, very big way over time. So in conclusion, 2025 really is a pivotal year for Tesla. And when people look back on 2025 and the launch of unsupervised full self-driving, true real-world AI that actually works, I think they may regard it as the biggest year in Tesla history, maybe even bigger than our first car, the Roadster, or the Model S, or the Model 3, or Model Y. In fact, I think it probably will be viewed 25 as maybe the most important year in Tesla's history. There is no company in the world that is as good at real-world AI as Tesla. I don't even know who's in second place. Like, you say, like, who's in second place for real-world AI? I would need a very big telescope to see them. That's how far behind they are. All right.
Great. Thank you very much, Elon. And Vaibhav has some opening remarks as well.
Yeah, I'll talk about things on Earth. As Elon mentioned, in Q4, we set records in vehicle deliveries and energy storage deployments in an uncertain macro environment. We were able to grow auto and energy storage volumes both sequentially and on a year-on-year basis. For this, I would like to thank the efforts of everyone at Tesla to make this a reality, and our customers who helped us achieve this feat. Coming into the fourth quarter, our focus was to reduce inventory levels in the automotive business. And we accomplished that by ending the quarter with the lowest finished good inventory in the last 2 years. This was a result of offering not only attractive financing options, but also other discounts and programs, which impacted ASPs. While we saw volume growth in almost all regions that we operate in, we hit a new record for deliveries in the Greater China market. This is an encouraging trend since we grew volume in a highly competitive BEV market. On the automotive margin front, we saw a quarter-over-quarter decline, primarily due to lower ASPs and due to the recognition of FSD-related revenue in Q3 from feature releases. Our journey on cost reduction continues, and we were able to get our overall cost per car down below $35,000, driven primarily by material costs. This was despite increased depreciation and other costs as we prepare for the transition to the new Model Y, for which we recently started taking orders in all markets. All our factories will start producing the new Model Y next month. While we feel confident in our team's abilities to ramp production quickly, note that it is an unprecedented change, and we're not aware of anybody else taking the best-selling car on the planet and updating all factories at the same time. This changeover will result in several weeks of lost production in the quarter. As a result, margins will be impacted due to idle capacity and other ramp-related costs, as is common in any launch, but will be overcome as production is ramped. We will be introducing several new products throughout 2025. We are still on track to launch a more affordable model in the first half of 2025, and we'll continue to expand our lineup from there. On a dollar-for-dollar basis, we believe we have the most compelling lineup today compared to the industry, and it will continue to get better from here. As always, all our products come with the best software in the industry, autonomy features, and capable of full autonomy in the future. And despite the premium experience, the total cost of ownership is close to mass market, less premium competitors. Energy storage deployments reached an all-time high in Q4 and resulted in, but declined sequentially. This was a result of growth came from Megapack and Powell. Both businesses continue to be supply constrained, and like Elon mentioned, we're trying to ramp up production with Megafactory Shanghai coming online this quarter onwards. While quarterly deployments will likely continue to fluctuate sequentially, we expect at least 50% growth in deployments year over year in 2025. Gross profit and margins in the service and other business was up year over year, but declined sequentially. This was the result of higher service center costs and lower profit from used car business. The businesses within service and other primarily support our new car business, especially through their impact on total cost of ownership. Therefore, while we manage them to be positive on a GAAP basis, we do not expect similar margins as the rest of the business. There's a lot of uncertainty around tariffs. Over the years, we've tried to localize our supply chain in every market, but we are still very reliant on parts from across the world for all our businesses. Therefore, the imposition of tariffs, which is very likely, and any reciprocity will have an impact on our business and profitability. Our operating expenses grew both year over year and sequentially. The biggest driver of the increase was R&D as we continue to invest in AI-related initiatives. The remaining increase came from growth in our sales capabilities and marketing efforts from referral program. For 2025, we expect operating expenses to increase to support our growth initiatives. It is important to point out that the net income in Q4 was impacted by a $600 million mark-to-market benefit from Bitcoin due to the adoption of a new accounting standard for digital assets, whereby we'll take mark-to-market adjustments through other income every reporting period going forward. Our free cash flow for the quarter was $2 billion, and despite CapEx increase of over $2.4 billion in 2024, we were able to generate free cash flow of $3.6 billion for the year. CapEx efficiency is something we are extremely focused on. While we have invested in AI-related initiatives, we have done so in a very targeted manner to utilize this spend to get immediate benefits. The build-out of Cortex was accelerated because of the actually helped accelerate the rollout of FSD version 38. Accumulative AI-related CapEx, including infrastructure, so far has been approximately $5 billion. And for 2025, we expect our CapEx to be flat on a year-over-year basis. In conclusion, like Elon said, 2025 is going to be a pivotal year for Tesla. There are a lot of investments which we've made and will continue to make in this coming year, which will set the pace for the next phase of growth. And it is something which now I'm getting out of Earth. It is going to be out of this world. And we just are putting the right foundation. And that's all I have.
Great. Thank you very much, Vaibhav. Now we will move over to investor questions, and we'll start with say.com. The first question is unsupervised FSD still planned to be released in Texas and California this year? What hurdles still exist to make that happen? You addressed the Texas piece, I think, already. So
yeah, I'm confident that we will release unsupervised FSD in California this year as well. Yeah. In fact, I think we will most likely release unsupervised FSD in many regions of the country, of the US, by the end of this year. Like I said, we're just putting a toe in the water, then a few toes, then a foot, then leg, then make sure everything's cool. And we're looking for a safety level that is significantly above the average human driver. So it's not anywhere like much safer, not like a little bit safer than human, way safer than human. So the standard has to be very high, because the moment there's any kind of accident with an autonomous car, this immediately gets worldwide headlines. Even though about 40,000 people die every year in car accidents in the US, and most of them don't even get a mention anywhere. But if somebody scrapes a shin with an autonomous car, it's headline news.
We want to avoid that.
Yeah. So it's really the only thing holding us back is an excess of caution. But people can certainly get a feel for how well the car would perform as unsupervised FSD by simply allowing the car to drive you around your city and see how many times did you have to intervene, not where you wanted to intervene or were a little concerned, but how many times did you have to intervene for definite safety reasons. And you will find that is currently very rare, and over time, almost never.
Great. Thank you very much. The next question is, are there any discussions with other auto companies about licensing FSD?
Yes.
Say the same thing every time.
What we're seeing is, at this point, significant interest from a number of major car companies about licensing Tesla full self-driving technology. What we've generally said is the best way to know what to do is take one of our cars apart, and then you can see where the placement of the cameras are, what the thermal needs are of the Tesla AI inference computer. That's better than us, sending some CAD drawings. And then we're only going to entertain situations where the volume would be very high. Otherwise, it's just not worth the complexity. And we will not burden our engineering team with laborious discussions with other engineering teams until we obviously have unsupervised full self-driving working throughout the United States. I think the interest level from other manufacturers to license FSD will be extremely high once it is obvious that unless you have FSD, you're dead.
Great. Thank you very much. The next question is Optimus now mostly design locked for 2025 production?
Optimus is not design locked. So when I say we're designing the train as it's going to, we're redesigning the train as it's going down the tracks while redesigning the tracks and the train stations.
Yeah, we've already answered.
Mm-hmm. Yeah, it's rapidly evolving. It's rapidly evolving in a good direction. It's pretty damn amazing, actually. The team's doing a fantastic job. We really have by far the best team of humanoid robotics engineers in the world. And we also have all the other ingredients necessary, because you need a great battery pack, you need great power electronics, you need great charging capability, you need great communications, good Wi-Fi and cellular connectivity. And of course, you need real-world AI, and then the ability to scale that production to huge levels. So you have to design for manufacturing. The things what other companies are missing is they're missing the real-world AI, and they're missing the ability to scale manufacturing to millions of units a year.
I think that is an underappreciated thing, that industrialization of design is a whole different thing than making a design.
Yeah, prototypes are trivial, basically. Prototypes are easy, production is hard. I've said that for many years. The problem is that there's those who've never been involved in production or manufacturing somehow think that once you come up with some eureka design that you magically can make 1 million units a year. And this is totally false. There needs to be some Hollywood story where they show actually the problem is manufacturing. I've never even heard of one. It just doesn't fit the narrative. The Hollywood thing is it's like some lone inventor in a garage goes eureka, and suddenly it files a patent, and suddenly there's millions of units. But listen, guys, we're missing really 99% of the story. 1% is that old saying of 1%. A product is 1% inspiration, 99% perspiration. The Hollywood shows you the 1% inspiration but forgets about the 99% perspiration of actually figuring out how to make that initial prototype manufacturable, and then manufactured at high volume such that the product is reliable, low cost, consistent, doesn't break down all the time, and that is 100 times harder, at least, than the prototype.
Yep. Then you have to get it there, deliver it back. Yeah,
you're going to meet all these regulations, and there's a zillion regulators around the world. It's very difficult.
Great, thank you. The next question is also Optimus related. When will Tesla start selling Optimus, and what will the price be?
Well, for this year, we expect to just close the loop with Optimus being used internally at Tesla, because we obviously can easily use several thousand humanoid robots at Tesla for the most boring, annoying tasks in the factory, like the tasks nobody wants to do, where we have to beg people to do this task, and then it's the robot's totally happy to do the boring, dangerous, repetitive task that no humans want to do. And that's also actually some of the easiest use cases for us to, have Optimus do things like, like load the hopper, like for, like say in Bodyline, if you're like transporting, pieces of sheet metal to the robot, which is already robot, the robot welding line for the body, and you just have to nonstop take things out of a from one fixture to another fixture, and it's a very boring job. That's the kind of thing what Optimus could do.
The guy who runs around and dumps all the weld studs in the bins.
Yeah, there's a ton of boring jobs, tedious jobs, dangerous, slightly dangerous jobs that's perfect for Optimus. So we expect to use Optimus for those tasks at our factories, and that'll help us close the loop for improvement this year. It's really with production version 2, which I think launches sometime next year. I'd like it to be the beginning of next year, but maybe it's more like the middle of next year. And then we have to just with a production line that is designed for on the order of 10,000 units a month versus 1,000 units a month. So like when you design a unit when you design a production line for 1,000 units a month, it takes you a while to actually reach anywhere close to 1,000 units a month. When you design, and for any given production output, it takes you a while to actually reach its potential. But the current line that we're designing is for roughly 1,000 units a month of Optimus robots. The next line would be for 10,000 units a month. The line after that would be for 100,000 units a month. And I think probably with version 2, that is a very rough guess, because there's so much uncertainty here. Very rough guess that we start delivering Optimus robots to companies that are outside of Tesla in maybe the second half of next year, something like that. But like, so this is such an exponential ramp that it'll go from no one's receiving humanoid robots to these things like coming out like crazy.
So we can't build enough.
Well, we're always going to be in the we can't build enough situation. Demand will not be a problem, even at a high price. And then, as I said, like once we're at a steady state of above 1 million units a year, I think the production, I'm confident at 1 million units a year that the production cost of Optimus will be less than $20,000. If you compare the complexity of Optimus to the complexity of a car, so just the total mass and complexity of Optimus is much less than a car. So I would expect that at similar volumes to, say, the Model Y, which is over 1 million units a year, that you'd see Optimus be, I don't know, half the cost, or something like that. What the price of Optimus is a different matter. The price of Optimus will be set by the market demand.
Great. Thank you very much. The next question is, what is the status on mass production of the Tesla Semi, and how will it impact revenue at scale?
I can take that one. So we just closed up the Semi factory roof and walls last week in Reno. It's ahead of schedule, which is great with the weather. In Reno, you never know what's going to happen, but we're prepping for mechanical installation of all the equipment in the coming months. The first builds of the high volume Semi design will come late this year in 2025 and begin ramping early in 2026. But as we've said before, the Semi is a TCO no-brainer. Like it's really similar to Optimus. It's going to be, set by how much people pay, and then it as a total cost of ownership, it's much cheaper than any other transportation you can have. So at that point, when we're at scale, it will meaningfully contribute to Tesla's revenue. Well, I think it's difficult to say how much. Anything you want to add, Elon?
No, I mean, I do think that Tesla Semi, again, with autonomy, is going to be incredibly valuable. That we actually have a shortage of truck drivers in America. That's one of the limiting factors on transport. People are human, so they get tired, and sometimes, there's. I have a lot of respect for truck drivers because it's a tough job. But because it's a tough job, there's not that many people that want to do it. And there's actually fewer, I believe, if my understanding is correct, there are fewer people entering truck driving as a profession than are leaving it.
Yes.
So when you think, yeah, exactly. So when you consider, okay, there's more people leaving truck driving as a profession than entering it, well, we're going to have a real logistics problem as time goes by. So autonomy will be very important to meet that need. So like, yeah, it'll I don't know. It's a several billion a year opportunity, which I don't know in this context, is that these days does several billion a year matter? I think it does. Not nothing. It's probably, it's probably like a 10 billion a year thing. Yeah, it's $1 billion a month at some point, probably. But it's all this is going to pale in comparison to Optimus. So, yeah, $1 billion a month it's a lot, but it's not. It's going to be like 1% of Optimus or something,
Great. Thank you very much. We already covered the next question in opening remarks. So moving on, is it expected that Tesla will need to upgrade Hardware 3 vehicles? And if so, what is the timeline and expected impact to Tesla's CapEx? I'm going to refer to cost there.
They're really asking the tough questions, aren't they?
I guess we haven't stopped working on Hardware 3 yet. We are still making software releases. We released the 12.6 release recently, which was it's like a baby V13, but it's a significant improvement compared to what they had previously. And people are still finding ways to distill larger models into smaller models. So we're not given up on Hardware 3. We're still working on it. Just the releases will trail the Hardware 4 releases.
Great. Thanks, Ashok.
Yeah. I mean, I think the honest answer is that we're going to have to upgrade people's Hardware 3 computer for those that have bought full self-driving. And that is the honest answer. And that's going to be painful and difficult, but we'll get it done. Now I'm kind of glad that not that many people bought the FSD package.
Wow.
Right, thanks, Elon.
He's
the next question,
that'll be included.
Has Tesla given up on ramping their solar roof product?
No, we're sorry, Mike. Oh, Mike, go ahead. Yeah.
Oh, yeah, I can take it. Yeah, solar roof remains a core part of the residential product portfolio, and it still remains where it draws a lot of customer interest despite it being premium products. We've worked on multiple iterations of engineering to make the product easier to install and distribute by reducing the SKU count. And more recently, rather than direct installation, we are focused on growth through our nationwide network of certified installers. And many of those, they've been installing solar roof with us for many years.
Yeah, that's actually turned out to be a much better way for is just let the roof, just supply product to the roofing industry. And especially when somebody's is getting a new roof anyway, or building a house from scratch, obviously this is by far the most efficient time to put in a solar roof, as opposed to putting a solar roof on a house where the roof still has 20 years of life. That's not economically sensible. But if it's a new house or the roof needs to be replaced anyway, then solar roof can make a lot of sense. And it is a premium product. It's like it's kind of like Model S, Model X or something. It's like it's a premium product. I think it looks really cool. And your house generates electricity, and if you combine it with the Tesla Powerwall battery, then you can be self-sufficient. So even if the grid turns off for several days, your house still works. And your roof looks awesome. So it's like, I recommend anyone who can afford it, get the Tesla solar roof and the Powerwall. Your family's life might depend on it.
Get enough.
And just in terms of convenience, your kids are not going to yell at you because their computers don't work because the power went out and you can't charge your phone.
True story.
Actually happens. Yeah. You literally can't even call anyone because your phone's out of juice.
Thank you very much. The next question was covered in opening remarks, so we will skip that. And the last question from say.com, what technical breakthroughs will define V14 of FSD, given that V13 already covered photon to control?
Well, we've gone a hell of a lot further than photons to output. We've been in sort of the nothing but nets situation, nothing but neural nets from photons to controls for a while now. We're just improving the neural nets. I guess we could get into some of the technical details to some degree. I have to say, I continue to be amazed by just how effective autoregressive transformers are at solving a wide range of problems. I mean, Ashok, is there anything you'd like to add there without giving away the sort of family secrets?
I mean, except for things we put on X already. Yeah, so continuing to scale the model size a lot. We scale a bunch in V13, but then there's still room to grow. So we're going to continue to scale the model size. We're going to increase the context length even more. The memory is sort of like limited right now. We want to increase the amount of memory it holds, like to even minutes of context for driving. We're going to add audio to handle emergency vehicles better. Add like data of the tricky corner cases that we get from the entire fleet, any interventions or any kind of like, user intervention. We just add that to the data set. So the scaling in basically every axis, like training compute, data set size, model context, and also all the reinforcement learning objectives.
Great. Alrighty. With that, we will move over to analyst questions. So just as a reminder, you will need to unmute yourself to ask your question. The first question will be coming from Daniel Roska from Bernstein. Daniel, please go ahead and unmute yourself.
Hey, good evening, everybody. It's Daniel from Bernstein. Elon, Tesla's share price clearly already includes quite a few of the anticipated benefits you talked about today, yet realizing what you call kind of difficult but achievable will take some time. What are you pushing the Tesla executive team to do differently now to accelerate the innovation in order to realize the value you described for the company?
Well, I mean, we're working on perfecting real-world AI and making rapid progress week over week, if not month, certainly month over month, but often week over week. I spent a lot of time with the Tesla AI team and the Tesla Optimus team. I mean, I go where the problem is essentially. Like, not, if something's, this is, unfortunate. Sometimes I don't talk to a Tesla executive and like, hey, we don't see you very often. I'm like, that's because your stuff is working awesome. Your stuff is working really great. Unfortunately, I don't see them very often because I go where the problem is. So, not where the problem is. Like, what's the greatest challenge that lies ahead? So, obviously, there are many challenges with Optimus. It's a hard problem to solve. Many challenges with vehicle autonomy, but we're making rapid progress in both.
Okay. I mean, sounds like you've got a conviction that the pieces you need, right, are in place.
Yeah.
If we kind of go 12 months down the line and we look back, and you had some of those, but maybe what are the kind of 2 or 3 KPIs that would tell you that you're on track and it's going the right way, and the pieces you've put in place are the right pieces, right? That's kind of what I'm looking for. Or other way around, where would it be off most likely in your mind that you say, hey, I need to go back there and I need to change something to enable the team better?
Well, I mean, I think the predictions that I'm making here are going to be pretty accurate. And it's worth noting, because sometimes people say, "Oh, Elon's always late." Well, actually, no. The problem is that the media reports on when I'm late, but never reports on when I'm early. So sure, I'm optimistic, but I'm not that optimistic. There are many cases in the past where we've been early. Such as completion of the Shanghai factory, or in fact, factory completion has generally been ahead of schedule, not behind. But I like I said, I'm very confident we'll have released unsupervised full self-driving, fully autonomous Teslas in Austin and several other cities in America by the end of this year. That's probably everywhere in America next year, and everywhere in North America at least. I think in terms of next year, our constraint, I think it's going to be just regulatory. Like Europe has, for example, Europe is a layer cake of regulations and bureaucracy. This is a joke like America innovates, Europe regulates. It's like, guys, there's too many refs on the field. For example, for us just to release supervised full driving in Europe, even though there's like this big EU country committee, we expect it to be approved at that time. But there's nothing we can do to make that may happen sooner. In fact, he seems to do unsupervised FSD a lot in Europe. I'm like, maybe next year, maybe? I don't know. Well, I have to find out when the EU is meeting again. Looking at videos of streets in China that are available on the internet to understand and feeding that into our video using SIM for bus lanes in China. Like the bus lanes are very complicated.
Everything seems opaque
instantly. So it's kind of a big deal, bus lanes in China. So we have to put that into our simulator, train on that. The car has to know what time of day it is, read the sign, and it will but I think we'll have FSD in almost every market this year, limited simply by regulatory issues, not technical capability. And then unsupervised FSD in the US this year in many cities, but nationwide next year. And hopefully we have unsupervised FSD in most countries by the end of next year. That's my prediction with the best data that I have right now.
Great, thank you very much. The next question will come from Adam Jonas at Morgan Stanley. Adam, please feel free to unmute yourself.
Thanks, everybody. Elon, you've said in the past about LiDAR, that for AVs at least, that LiDAR is a crutch, a fool's errand. I think you even told me if it was free, you'd say you wouldn't use it. You still feel that way? Care to elaborate, or just, I have another question.
Look, we have a radar in the car and we turned it off.
I got it. All right, so you're still, yeah. People think you're crazy, but for not
look, I mean, obviously humans drive without shooting lasers out of their eyes. I mean, unless you're Superman, but like humans drive just with passive visual. Humans drive with eyes and a neural net and a brain neural net. So sort of biological, so the digital equivalent of eyes and a brain are cameras and digital neural nets or AI. So that's the entire road system was designed for passive optical neural nets. That's how the whole road system was not designed, and what everyone is expecting that's how we expect other cars to behave. So therefore, that is very obviously the solution for full self-driving as a generalized, but the generalized solution for full self-driving, as opposed to the very specific, neighborhood by neighborhood solution, which is very difficult to maintain, which is what our competitors are doing.
I got it.
Yeah.
I mean, LiDAR doesn't work in the fog, guys.
LiDAR has a lot of issues. Like I don't have some like the SpaceX Dragon docks with the space station using LiDAR, that a program that I personally spearheaded. I don't have some fundamental bizarre dislike of LiDAR. It's simply the wrong solution for driving cars on roads.
Right. You understand how LiDAR works. I get it.
Literally designed and built our own red LiDAR. I oversaw the project, the engineering of the thing. It was my decision to use LiDAR on Dragon, and I oversaw that engineering project directly. So I'm like, we literally designed and made a LiDAR to dock with the space station. If I thought it was the right solution for cars, I would do that, but it isn't.
Got you. All right. Just as a follow-up, at CES, you said, I'm paraphrasing, that any AI will be able to do any cognitive task not involving atoms within the next 3 or 4 years. And that would imply, Elon, that before the end of President Trump's term in office, that AI would be moving pretty damn quickly into the physical world, into the world of photons and atoms. And I'm thinking, given your work with the administration, how confident are you that the U.S. will have the manufacturing and the supply base to make good on your excitement about physical AI by the by latter this decade? We seem pretty vulnerable right now. I've seen you tweeting about, or sorry, Xing, excuse me, Elon, about China. Freudian slip, about China making more drones in a day than the U.S. makes in a year, and all the entanglement of the supply. So what has to happen in the U.S. to make that possible? What's your message, and what can you do about it, and what's relevant for Tesla shareholders? Thanks, Elon.
Well, at Tesla, obviously, we think manufacturing is cool. SpaceX, we think manufacturing is cool. But in general, for talented Americans, they need to, beyond my companies, beyond me and the people and my teams here, in general, we need to make manufacturing cool again in America. And I honestly think people should move from law and finance into manufacturing. That's my honest opinion. We have too much. This is both a compliment and a criticism. We have too much talent in law and finance in America, and there should be more of that talent in manufacturing. I mean, at Tesla, we're making sure that we can continue to manufacture our stuff, even in the event of geopolitical tensions rising to very high levels.
Great. Thank you very much. The next question will come from Pierre Ferragu at New Street. Pierre, please feel free to unmute yourself.
Oui.
Hey, thanks, guys, for taking the question. So I have a question, Elon, on deploying robotaxis in June in Austin. So that's great news. And I was wondering if it means I can, drive down to Austin in June and try unsupervised by myself with my car. Yeah. Or it's going to be more like your fleet testing it.
It'll be our fleet testing it. So that's our sort of toe in the water. We'll be scrutinizing it very carefully, make sure it's not something we missed. But it will be, autonomous ride hailing for money in Austin in June. And then as swiftly as possible, other cities in America. And I expect us to be operating, doing unsupervised activity with our internal fleet in several cities by the end of the year. Then it's probably next year when people are able to add or subtract their car from the fleet. So, kind of like Airbnb, where you can sort of add or subtract your house or your guest room. You can say add it to the Airbnb inventory or don't add it to the Airbnb inventory. If you're traveling for a month, you can, or whatever the case may be, you can let other people use your house, and then you can. Anyway, so that's probably next year, because we want to just make sure we've ironed out any kinks. And a lot of it is, it's not like we're not splitting the atom here. It's just a bunch of work that needs to be done to make sure the whole thing works efficiently, that people can order the car. It comes, it's the right spot, does exactly the right thing. All the payment systems work, the billing works.
Okay. But then, so my follow-up question would be, I have a Tesla, I have FSD, and I have to keep my eyes on the road all the time. It's super boring because I don't really need to intervene anymore. Yeah. And but the really annoying thing is that I can't just check my emails. And so, are you working also on introducing, a kind of free unsupervised, where I could be eyes off, and I would be able to check my email, and would just need to, with a 5-second notice, have to go back and keep an eye on what's happening. Or is that something you're working on as well? Because it feels so close with V13 that I wonder if it's something we could expect for this year. It's a very selfish question I ask for myself, to be honest.
Yes. We need to be very confident that the probability of injury is low before we allow people to check their email and text messages. In fact, right now we're in this perverse situation, which you may have encountered yourself, where people will actually go to manual driving to check their text messages. So the computer doesn't yell at them, and then put it back on autonomous mode once they've checked the text messages, which is obviously less safe. Significantly less safe. Significantly less safe than just letting people check their text once in a while without the computer yelling at them. But we just want to be cautious about that at the advent of that. We're in this sort of, neither here nor there, but just for, I think it's not for many months longer. But yeah, we're in this perverse situation where people will turn the car off autopilot so the computer doesn't yell at them, check their text messages while steering the car with their knee and not looking out the window.
And there, like Elon said, right? If you have any problems with the system, and when people are not looking, that is a dangerous thing. And that's what we're trying to avoid. It's the capability is getting there, but it's not fully there. That's why he was using the term of dipping a toe in the water, then getting comfortable, then keep going.
Anyway, it's not far off. But we want to prove to ourselves, prove to ourselves, and obviously prove to regulators that the car is unequivocally safer in autonomous mode than not. And we're not far off. So this is like low single-digit months.
To the safety aspect, we did publish our vehicle safety report today, and in Q4 was one crash for every 5.9 million miles driven, compared to a crash every 700,000 miles without autopilot.
Right. So we're getting to the point where it's an order of magnitude.
Yeah, it's like 8.5 times safety. So it's just about there.
Yeah,
it's amazing.
Great. Alrighty, and our last question will be coming from Dan Levi at Barclays. Dan, feel free to unmute yourself.
Great. Good evening. Thank you for taking the questions. Elon, you've talked about the need for proliferation of sustainable transport in the past as part of sort of broader push to sustainable energy. Look, I know we've heard a lot about President Trump's plans to reverse the EV mandate, and I think there's a view that given regulation is a driver of EV uptake, this could slow EV uptake in the U.S. So what would be your view on the right policy in the U.S., given your comments in the past of the need to push for sustainable transport?
At this point, I think that sustainable transport is inevitable. I'm highly confident that all transport will be autonomous electric, including aircraft, and that it can't be stopped any more than one could have stopped the advent of the external combustion engine, the steam engine, or one could have stopped the advent of the internal combustion engine. Like even if you've been the biggest horse advocate on earth, horses are the way, not these newfangled automobiles. You can't stop the advent of the automobile. It's going to happen. And you can't stop the advent of electric cars. It's going to happen. The only thing holding back electric cars was range, and that is a solved problem.
Great.
And then as a follow-up, in the past, Elon, you had made a comment that, you'd be willing to sell cars at effectively no margin to get the cars out there. And there's a comment in the release today of the rate of acceleration of autonomy efforts does impact volume growth. So perhaps you could just talk about, with your efforts on FSD, how we should think about your desire to put more vehicles out in the market to take advantage of your tech advances.
So I'm not sure I understand the question. But we have a lot of cars. I mean, we've got millions of cars out there.
So is your question, Dan, that how do we marry our future growth aspects with FSD?
And yeah, go ahead and unmute yourself, Dan.
Yeah, more so just how much more aggressively you would be willing to, sell your cars versus in light of your improvements on FSD.
Well, right now the constraint we're trying to solve is battery production as opposed to demand. So now Q1 we've got this massive factory retooling for the new Model Y, for example. That obviously has a short-term impact on output. But the problem we're wrestling with, in fact, we're talking that the executive team and I were talking about just before this call was how we've got to figure out how to increase total gigawatt hours of battery production this year, one way or another. That's the constraint on our output.
Great. Alrighty, and with that, I think we are all out of time for today. So thanks everyone so much for all of your questions. We look forward to talking to you next quarter. Thank you very much. And goodbye.
So let's go ahead. Not only am I going to do a summary of that, but I just noticed that Microsoft is down, Nvidia is down. Like Microsoft's down like 5.7%. So we need to figure out what the hell just happened over at Microsoft. So I'm going to go through this because I think this actually, like, honestly, the Tesla one was a little boring. None of this was a surprise. Don't get me wrong. I'm going to go through the summary, and I've got a lot written down, but it was pretty straightforward. There wasn't anything shocking there. And we didn't get a car announced. So I'm just going to say quickly, let's see here. No new model announced. Obviously, they don't announce on calls. All right, so Microsoft. For Microsoft, it says Nadella says DeepSeek has some real innovations. Oh, there we go. Okay. CapEx Q3, Q4 to be similar to Q2. Operating margins to be up slightly. Fiscal year 2026 to be slightly lower than last year. CapEx to be slightly lower than last year. Why is this? Company has seen significant efficiency gains in AI. Yeah, that's kind of like what we talked about, that they might say. Efficiency gains in AI. Okay, so why is it down so much? Okay, Zuck. Let's see what he has. Hopes to implement DeepSeek advances in meta systems. It's literally exactly what I thought they would say. Okay. DeepSeek advances at Meta. Okay. Is it just you, or is my mic fluctuating in value? I see your head. Yeah, it is. No, you were right. This is what it should be. Sorry. My bad. I gotta go through and clean that up. It's the downside of kind of a new setup. You haven't found all the bugs yet. Okay, so what is going on though with... Okay, then we've got Zuckerberg. We got that, we got that. We got that. That's annoying. let's see here. Goal is to get AI tools to scale this year. Business opportunity for AI will come next year. Oh, that's interesting. Business opportunity from AI coming next year. For monetization questions. Let's see here. I'm surprised Elon didn't get asked about it. Monetizing AI, hoping to implement DeepSeek. We got that. That was a big question. Zuckerberg mentioned DeepSeek. Open source standard globally. Important to see the standard American made. Strengthen their conviction. No changes yet. This is exactly what we expected. Okay. I'm just very curious to see why specifically Microsoft got hit so hard. Because Microsoft was talking about a shortage of data centers. But on one hand, they're like, oh, we have a shortage of data centers. But then they're also saying they're not going to spend as much on CapEx. So, little confusing. CapEx in the last quarter was larger than expected at Microsoft. Okay. NVIDIA's down 1%. Not so bad. It's Microsoft that's down more. I'm trying to see why. It just has to be because of this DeepSeek comment. MSFTs. Let's see here. Okay, Microsoft call dragged it down. Some people say yes. Expect capital expenditure. Okay. Don't see anything else specific. Oh well. Oh wait, what is this? We expect to continue investing in strong demand signals. However, the growth rate will be lower than 2025. And we will begin to CapEx growth, yeah, there it is. CapEx growth to be lower than 2025. Growth rate lower. Okay. So that seems to be the big thing that's frustrating people. Yeah. Okay. Well, we'll do a full summary here in just a moment. Okay. Well, we shall go through all of it. See what we can make of it. Okay. So, let's see here. Let us get ready for a good old summary video. Okay. Okie dokie. All right, give me 1 second here and we'll get this up and going. Okay. Okay. Go. All right, here we go. Thanks for patiently waiting. Well, what did we just hear from Microsoft, Meta, and Tesla? And why the heck is Microsoft down 5.4% in the after hours, whereas Tesla is up 4% in after hours, Nvidia down about 1.25%, and all these numbers obviously could shift and flip and flop all over the place, but a lot of people are wondering what's the news, what's going on, so let's get through it. So first of all, Microsoft missed slightly on cloud. Now, they're blaming not having enough data servers available for them to satiate the Azure demand that there is, but some people are scratching their head going, wait a minute, how do y'all miss on intelligent cloud? Now, they only missed by about 1.35%, so it's not that big of a deal in terms of the miss, but I think the markets were a little bit more spooked because, remember, we went into this expecting Microsoft and Meta to say something like, hey, we have no plans to spend or change our capital expenditures, but we will see what we can learn from DeepSeek and incorporate it into our efficiency models at the company, right? And guess what? Facebook, which is up 2% right now in after hours, said literally exactly this. It's almost like they listened to my video before earnings, here's what Meta's likely to say, and they copied it. Microsoft didn't listen to the video. Meta said, hey, right now we still anticipate our CapEx to be between 50 and 65 billion. That's up from the 51 they previously projected. And they, quote, hope to implement DeepSeek advances at Meta. They see business opportunities from artificial intelligence coming next year in terms of being able to actually monetize artificial intelligence, but it's too soon for us to make any kind of changes to our capital expenditure guidance, just 2 days after the release of DeepSeek, essentially. So Meta sort of looked at this and was like, oh, yeah, like, we can't make any changes yet on our CapEx, but oh, absolutely, we're gonna end up we're gonna be more efficient, we're gonna learn what we can, and open source is the future. Yeah. Okay, cool. So that was Meta's take to DeepSeek. Well, what did Microsoft say? Microsoft, instead of saying this, came in and said, well, so we missed on cloud. And Kathy Wood, by the way, is complaining that Microsoft is seeing growth decline, and so we can kind of explore that more deeply separately. But when it came to Satya Nadella speaking about DeepSeek, he says DeepSeek has some real innovations, and we actually see CapEx growth being lower this year than it was last year, and there are definitely significant efficiency gains to be had from artificial intelligence. Now, this is really interesting because you kind of have this like duality here. And my take is markets are looking at Microsoft going, okay, like y'all are high margin. Y'all obviously would be a beneficiary of more efficient AI, but only to the extent that you can actually grow on share. And I think they're getting beat up here a little bit unfairly, but I think they're getting beat up on missing that cloud growth. I think markets might be looking at Microsoft going, okay, well, if y'all are going to be more efficient, we want you to sell more, but you're not selling more, so we'll go somewhere else. But honestly, it's not just Microsoft getting beaten up after these earnings. It's Salesforce is down 3% after that Microsoft miss as well, possibly in sympathy, and they've been running quite a bit over the last few days. Meta's still holding on to its 2.2-ish%, but that's probably because Meta makes most of their money from advertising, and frankly, they're crushing it with advertising. I mean, look at Meta numbers, for example. The average price paid for an advertisement at Meta is up 14% year over year. That is phenomenal growth over at Meta. You've also got to remember that even though they missed on their guidance by 2.5%, their numbers across the entire world are frankly great. You look at ad revenue growth at 28% at the rest of the world, 48% operating margin. Their costs only up about 15%. Well, they're really exploding with not only advertising, but also the potential side of innovation. Mark Zuckerberg, for example, started by talking about the Ray-Ban's Meta glasses and how, hey, the market will tell them if this is something that billions of people are going to want to use or if it's going to be a slow slog or grind. So it seems like for some reason markets were really resonating with Meta here a little bit more. ServiceNow was another one of those software businesses that just disappointed with the subscription outlook not great, and the stock down about 8% in after hours after they had a miss on their guidance. So it seems like markets today are saying, look, that's cool. Y'all can be more efficient because of DeepSeek. Y'all are reiterating the innovations that are happening with the DeepSeek technology, but we need to see big dollars coming to the bottom line and growth. And if you're not going to grow, like Kathy Wood said regarding Microsoft, then maybe this isn't the place to be. And so I think that's kind of why you started seeing Microsoft trade down a bit. Not only that miss, but also that mention that we're going to focus more on short-lived assets, so basically focusing on more near-term spending. That could be like a marketing campaign, right? Like, oh, we'll market our business and we'll use that marketing expense this year and that's it. As opposed to like a longer-term asset, which would be like another data center. So they're kind of in this duality where they're like, on one hand, we're data and compute constrained, but on the other hand, things are getting more efficient and we don't want to keep building data centers because maybe we'll just sort of converge into that efficiency. Now, that's kind of a complicated idea right there. So I want to draw that one out. And I'm not saying that you can't understand it. I think the way that I'm conveying it is a little bit complicated, but I think it's actually really important for us to think about. So let's grab a page on the iPad here. And let's draw this out, this thesis. And then I want you to tell me what you think about this thesis. And let's see if we're on the same page on this puppy. All right, so, and then of course we'll do our Tesla earnings. So I think there's a chance with what Microsoft is doing is they're saying, look, we have spent a lot of money on artificial intelligence, right? So spending on AI infrastructure, let's call it this, right? That's spending on AI infrastructure. And then let's go ahead and draw a AI needs curve. So we'll do, we'll kind of draw this logarithmically. AI needs curve. Actually, it's kind of like logarithmically, and then it turns more, what is that, parabolic? Upside down parabola. So let me label this. And then I'll sort of put like where we are now. I'll call this the now. It feels like, and I could be wrong about this, but it feels like this is what they're talking about. So spending on AI infrastructure is this. That's the now. And this right here is AI demand, right? So they're at a place where right now there's a shortage. This section right here is the shortage. But the problem is because AI is getting more efficient, they actually see in the future a collapse in the need for data centers that they have. And so if they stop building, let's say they stop building right here, eventually what this section right here is going to be is excess compute. And I think when we get into the Tesla earnings, you're going to see some of that as well, though Tesla didn't get punished as much because Tesla has the argument of, well, Optimus robots are going to need way more compute. So just stay tuned. And I'll talk about Tesla in just a moment. But to me, I think, like, I personally would consider taking a screenshot of this right here. I'm not saying that's because this is like beautiful art. It's because I really think if you're an investor, you want to look at this critically and you want to make an opinion about this. You want to say, do I agree with this? So again, the dotted line is where we are now. The orange vertical line is spending on AI infrastructure. And the reason it's not exponential is because there's a limit to how quickly you can get chips and machinery. Machinery just sort of grows linearly. It doesn't really grow exponentially, whereas demand can, right? Demand can grow overnight like we saw during the pandemic, but actually manufacturing stuff doesn't usually grow exponentially. It usually does this stair-stepping thing where it probably practically looks like this, and then the linear line is really just the average of it, right? But the point is, if AI demand is so explosive to where, yes, we're compute constrained, but then you have Microsoft saying, we actually don't need this much Like, we're not going to invest that much anymore into CapEx. Like, we're going to slow our CapEx growth. I think that's because they actually see those efficiencies at some point, putting them in a place where they're going to have a substantial excess of supply of compute. Like, think about this. Like, take this out, I don't know, 3 years when it's all built, okay? So you really need new demand sources for this stuff. Go out into this direction over here, and what you end up with is this entire section right here, all of this widening, this all becomes excess compute. What you need are more purposes to fulfill this excess compute. And so what's an example of excess compute that can actually push that red line up, or that sort of demand curve up? What can do that? Well, honestly, Optimus is something that can push this curve up. And so I think that's why Tesla is reacting a lot more positively in the after hours, at least right now. Stock's up over 3%. It was down as much as 5% when it first missed on its numbers. And we're going to talk Tesla here in just a moment. But really, when you listen closely to what Elon said, what was different this time was that they talked in their shareholder deck about how they have this 50,000 unit server cluster. In fact, I have a picture of it right here. Where is it? Right here. It's the Cortex 50,000 GPU training cluster. That was different. Something else that was different was them recognizing $600 million of revenue from Bitcoin as a mark to market, which also means if Bitcoin's going to go down in the future, they'll have to take the hit. But the fact that they took a $600 million bonus to their income, and they still missed earnings per share on an adjusted basis by 2 cents. They missed revenue by $1.5 billion. And their gross margin came in at 16.3% versus the estimate of 18.9%, with margin excluding regulatory credits at just 13.6%. These numbers were not good. But the thing that actually kept them going was that they have more compute, but not only do they have more compute, they have the purpose. And so that is the opposite of what Microsoft is feeling. Because again, compare this. Microsoft equals more compute, but miss on demand, right? And then at Tesla, what you actually have is more compute, more demand coming via Optimus. So this is a very different artificial intelligence story. They're not really reliant on an outside source for keeping their servers busy. And I think that's one of the reasons why Tesla got rewarded here, even in the face of crap margin. But then again, remember when I did my earnings preview, we talked about this with course members in the Alpha report. We talked about this in videos on the channel. I talked about this everywhere, okay? I think I was as clear as I could possibly be here, that the Tesla earnings today were never going to matter about the vehicle margins or vehicle deliveries. We already knew all this stuff was going to be crap. It was all going to be about the future. Optimus, when are we going to get it? Oh, okay, you guys are going to try to build a few thousand by the end of the year to have them functional in factories. And then you want to get to ideally 10,000 a month at some point in the future. Your first line will be 1,000 a month. Then the next line will be 10,000 a month. Then you'll be at 100,000 a month. That's awesome. That's really exciting. Okay, what else can you tell us? Oh, you're going to start doing cybercab tests in Austin, potentially in June. And you're probably going to release full self-driving unsupervised later this year in California and Texas, and then other parts of the United States this year. That's great. Hey, what about hardware, hardware 4? Oh, crap. Cars with hardware 3 are going to have to upgrade to hardware 4 to probably get unsupervised. Oh, no. And then to that, Elon's like, good thing a lot of people didn't buy the FSD package, because he's basically implying that they're going to provide that upgrade for free because, yeah, you're going to need a hardware upgrade. You're going to need a new computer upgrade to actually get to this level. So it'll be interesting because I've got 2 cars. I think actually one of them might still be on hardware 2. But anyway, I've got 2 older ones, and then I've got the Cybertruck, which is on hardware 4. So we'll see, I guess. But anyway, they also still sort of tease this idea about the launch of a new, more affordable model, but nobody's asking questions about it, or they're purposefully dodging questions on it and not even having them ask those questions. They keep teasing it. They mention it in their prepared remarks. They mention it in their shareholder deck that, more affordable model should come in 2025. But they never talk about, is this going to be a whole new car? Is this going to be like a refreshed version of some existing product? Is this just going to be a low battery variant of something that we already have, like a lower, smaller battery Model 3? They also have an interesting slide where they kind of suggest they're not going to use the stainless steel ever again in future products. So maybe they kind of learned a poopy doopy lesson there. See right here, they say use in future vehicles, and they check mark steer by wire, adaptive air suspension, custom laminated glass, ether lube, 800 volt battery system, 48 volt architecture. That's how you don't get the 12 volt cigarette lighter anymore. It's actually kind of annoying if you have old cigarette lighter products. But look what's not going to be included. The stainless steel exoskeleton is not going to be used in future vehicles. So I thought that was kind of interesting because that sort of implies that they're not really planning on a future version of like a cyber truck or a cyber van, and instead it'll be more like the Robovan or whatever. They talked about coming out with Apple Watch support through their app. I guess I need to get that app update because I'd love to have the key on my watch instead of on my phone. That'd be really cool. Talked about how they're producing a 2,500 Cybertrucks worth of 4680s. And Mega Factory Shanghai was completed in Q4. That's all fantastic. Then we've got they've got the roof going on the Reno facility for the semi-trucks. They expect to manufacture semi-trucks in next year. Elon Musk, as usual, and almost, I mean, frankly, I predicted it on the live stream. You should go watch it just because it's a meme at this point. I'm like, well, Elon's going to get off playing Diablo or whatever he's playing, and then he's going to get on the radio or, his phone and be like, oh, what are we doing, guys? Oh, earnings call? Tesla is going to be the most valuable company in the world. And then today, he actually surprised me because he got on and he goes, Tesla is not only going to be the most valuable company in the world, but it's going to sound like Donald Trump, and it's probably going to be worth 5 times as much as the most valuable company in the world today. It's going to be huge. It's going to go ballistic. He had a lot of excitement at the beginning. Let's just say everybody's so used to hearing it at this point, it didn't move the stock at all. But that's okay because the stock really shouldn't move off that because it was kind of just like a pump. We really want to hear updates. And so, again, very, very optimistic. But he kind of goes through the usual, how useful an autonomous car is going to be in the future and blah, blah, blah. But really, they want to toe into doing FSD trials in June in Austin as an initial operated by Tesla. And hopefully they'll have a few thousand Optimus robots at the end of the year operating in their facility. And then next year we get into more volume production for Optimus and Cybercabs, probably where then they can expand the robotaxi service, so to speak. So internal only for now. They do think that they can get the Optimus cost down to $20,000 and cost of goods sold, which is actually pretty good given that their COGS right now in a car is about $34,000, $35,000. But their average selling prices have gone down. Their average selling prices are so low right now that they're at the lowest margin per vehicle right now that they have seen since 2018, and that's before the EV tax credits go away. So, some potential pain on the actual EV and the manufacturing side, but again, the market is rewarding the enthusiasm because yes, as AI becomes more efficient, it'll actually be a big boon to Tesla. So the DeepSeek model would be a huge boon to Tesla because really you're able to likely operate artificial intelligence at, frankly, a much more cost-effective level of energy or spend, essentially, to accomplish, hopefully, that 10x requirement that Optimus robots are going to need since they're going to be doing, as Elon says, so many more things than just what a car does. So anyway, that gives you a little bit of a DeepSeek impact on the Tesla earnings, currently up about 4.4%. Microsoft earnings currently down about 5.28%. And Meta earnings currently up about 1.8%. There you have it. Check out meetkevin.com. Thank you so much for watching, and we'll see you in the next one. Oh, by the way, make sure you go to meetkevin.com. Coupon code expires in 2 days. It will include lifetime access to the Meet Kevin Alpha report every morning. We will start charging for that at the end of February. So get in now before the price really goes up and more content comes out. Check it out at meetkevin.com. Any questions, always email us at staff@meetkevin.com. But for now, we got to talk DeepSeek. All right, folks. Thanks so much for being here. We'll see you soon.